The bar is very high here for a lot of those stocks, particularly if you look back to last quarter. A stock like Microsoft, a stock like NVIDIA, which were considered consensus longs, still managed to rise considerably on earnings, and I think they now face the challenge of backing that up.
Headline out right now: Delta Airlines thanks the Abramowitz fan for profit-making travel in July.
Thank you. Yeah. Are you just basically
it just continues?
tweaking my
Walgreens tanking as we go, and Delta out with a complete redo. Lisa, why don't you visit it here? Free cash flow was greater than $2 billion. They popped FCF up to $3 billion. I believe that's a 50% lift on free cash flow.
Well, this has been the perennial story, right? That people keep traveling, that the distortions post-pandemic have continued. Given some of these post-pandemic distortions, and we were talking before we went on about how people do keep on spending, and maybe they were conditioned by remaining cooped up and feeling like they have to seize life at the horns, or whatever kind of psychological rationale you want to put on it. But Stuart, how does that color your view of whether you're more optimistic or more pessimistic once we get the reality of these earnings?
Look, I think it's earnings, and to your point, is consumer spend and employment. And if we're going to have a recession in the second half of the year, it's going to have to come from the consumer side of the market, right? So that's why there's so much focus on the labor market. I think going into earnings, there's a high bar for tech, mostly because tech has been leadership of the market, and I think there's a high bar, a lot of focus on consumer companies just to see if the spending is following through. Are they continuing to be able to pass through inflation, or are they starting to have to discount, to get people in the door? So I think those are the two areas we'll probably focused on the most for earnings coming up: is can tech hit the bar, and what signal are we getting on consumer spend?
What does it mean that tech earnings is a minefield? That whole period is a minefield at a time when you've been pretty optimistic about where the market's heading?
Yeah, look, the tech trade is obviously not, as we've said, as clean as it was, at the beginning of the year. And I think the bottom line here is, if you look at sales revisions, if you look at EBITDA revisions, they've been, higher for tech and even higher in the AI space. So that kind of sets your bar, a little bit higher for expectations. And, what we've seen the last, I would say, 1 to 2 months is long-only investors in particular starting to have some fatigue in terms of tech buying. We're starting to see some outflows from the space. So you put those two things together, you have a high bar and what looks like some fatigue on the institutional side, and that just, to your point, sets it up that you need to deliver results here to kind of justify your performance on a year-to-date basis.
I want you to talk to market timers right now. You have been brilliant, Bale and the rest at Citigroup, about saying you got to be in the game to win. Talk about market timing right now, the efficacy of being hyper cautious versus the optimism I hear from Citigroup.
Yeah, look, I think even our optimism is starting to get a little bit tired, to be completely honest with you. Partly it's price action, and partly it's one of the reasons we were kind of more bullish coming into the year was so much stock had been sold last year, and we thought that those positions kind of needed to be rebuilt. And just the data we're seeing on flows suggests that those positions have largely been rebuilt. Call it you're 75% of the way, along that path. So from our perspective, it does kind of impact risk reward a little bit. So look, we are still relatively positive. Gun to our head, we'd say up rather than down at this point. But the risk reward is definitely.
But that's the nature of a bull market. I'm sorry, we're not in the first leg off the mat. Bramo was wicked gloomy the third week of October last year, and guess what? We all got off the mat and went. It's not supposed to be like that now, right?
No, it's not. For a number of reasons. One is you've had a tremendously positive economic data surprise to start the year. That's flowed through to earnings expectations as well. I think that's helped lift the market. But look, you get above 4,400, and it looks like institutional investors at least have started to just sort of call pause a little bit in terms of their inflows into the market. So that means one of two things. Either I think you need to take recession risk out of the system, which would be your next leg higher, or you're going to need, retail to continue to sponsor this market to the upside.
Are you one of those people who says if there is a sell-off in tech, it's a buyable dip? That's what I keep hearing from everyone.
Look, I think if there's a sell-off in tech, I think that means markets are down in general. You're not going to get tech down with markets up, right? So every dip is a viable dip, I guess. But, from our perspective, I think if you get a pullback here, I agree with you. I think there are a lot of people waiting to get into the market, a bit lower, which probably means, right now we're in the pain trade to the upside. People didn't want to chase it. I think what you'll probably have is people buy a little too quickly on the way down, and then kind of have to average themselves in. The floor is clearly higher than it was to start the year. I agree with you. I do think you'll see some, I don't want to call it value picking, but you'll definitely see some people who'd be happy to buy the market, call it 5 to 10% lower here, which, as you know, limits the downside. Right?
I don't know if you knew this. This is brilliant, Stuart. Thank you so much. But Bramo's got the East Bay 44 from Grand Banks on delivery later this summer. It's gorgeous with a light blue. And
I don't even understand what he's saying.
She's named it Viable Dip. It's just great. It's a picnic boat for Bramo to have a picnic boat. It's like the Hinckley one, but I think it has more character than the Hinckley picnic boat.
I think I got lost in the blow-up paddle board instead. That's sort of my speed, but
the
carry on.
Hinckley was great. I love the side thrusters, but I'm sorry, the East Bay's better. And you might.
When was the last time you were on a boat? I mean, come on. When was the last time?
My boat was called the USS Dramamine.
Yeah, exactly. That sounds more like it.
Well, Stuart Kaiser, just brilliant. Come back. Bring Jeff Yu with you from BNY Mellon. Do it every day. Kaiser and you. Stay with us. Futures up 9. This is Bloomberg Surveillance. Good morning.
Tom, let's dig in some of these Walgreens details, because I do think that this is interesting. Just to reiterate, they do see the full year adjusted earnings per share of $4 to $4.05 versus a previous estimate of $4.45 to $4.65, saying guidance reflects consumer and macroeconomic conditions. Again, is this going to be the weather, macroeconomic, or is this going to be something where you dig under the hood and it is a select group of people that are getting disproportionately affected by inflation and by maybe a softening market or softening economy?
I would say that in each and every battle of contraction, slowdown, growth recession, outright pain, which nobody's really calling for right now, it is lumpy. And I don't like the phrase rolling recession. I've never liked it. I've never seen a real quantifiable study of that. Maybe David Rosenberg can correct me on that, or the great Ed Hyman. But the bottom line is, it's lumpy always, where some things win, some things don't. And some of that's due to technological change.
In other words, Amazon stealing their lunch. And how much is that really what we're hearing? And not just Amazon, but we're seeing that from Walmart too, which has really improved some of their online presence. You have to have a certain amount of investment to then get the critical mass to finance the new world, which is a, tech-induced
it is the effect of technology on all this. And Amazon off the mat. I mean, let's recall 180 to 80 on the pandemic overbuild. Thank you, Jeff Bezos. And Joe's, they're back a third. They've gone 80 to 127. That's the great Seattle bounce. That was my technical analysis for
fantastic.
The day. Stuart's over here taking notes. Coming up in the next hour, Cameron Dawson will join us here in the 8 o'clock hour. Looking forward to that. I'm watching oil, 68.44 American oil. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become
the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Gave Putin no excuse to blame this on the West or to blame this on NATO. We made clear that we were not involved. We had nothing to do with it. This was part of a struggle within the Russian system.
The President of the United States delicately yesterday within the Russian system. President Biden there speaking on all that we've seen out of Russia in the last 72 hours. We were hugely valued yesterday by a brief by Anne-Marie Horton, our Bloomberg Washington correspondent, with all of her heritage of travels within Russia over the years. And of course, foundationally with Maria Tadeo in Brussels. And they join us today for a morning brief. Maria, I'm going to go to you first. Can you describe to me what within the Russian system means? The president used that language, and I'm fascinated by your interpretation. What is the Russian system right now?
Yeah, President Biden came out and said this is not related to NATO. I think at this point it's pretty clear what this was about. This was an internal power struggle. And today, Alexander Lukashenko, the head of Belarus, also said that. He said, quote, "We let this situation get out of hand." Probably when he says we is Wagner, it's Putin, and it's also himself, who's now in the midst of this deal. Now, in terms of today, Tom, what we see this morning is a real effort, not just the optics, forget about the optics, but also in the actions by the Kremlin to say this crisis is over. It's clear there has been an ultimatum that's been given to Wagner. You give the weapons, you go away, and the troops, you either join the Russian army or you're out. And then again, this idea from Vladimir Putin today, saying and repeating, you averted to his troops a civil war, and now we go back to normal. To me, the big question now is how will this affect the war in Ukraine? Because Wagner performed better than the Russian army.
Anne-Marie Horton, within the Russian system, your perspective on how the institutions of Washington should react, particularly if the Russian system has 1,674 deployable ICBMs pointed west.
Well, I was actually struck by Viktor Orban's comment in an interview he gave to Bild, which he said, if someone speculates that Putin might fail or be replaced, then they do not understand the Russian people and the Russian power structures. What he is talking about is the power structure that this is, in essence, a military and a security state. The FSB, the military, obviously the Kremlin. None of those agencies came behind in support of Yevgeny Prigozhin, and that is why this was obviously a failed mutiny, and it dissolved very quickly, even though Putin had to step in at the brink. My question is why he did not get in sooner, when for weeks and months he knew that Prigozhin was just exasperated with the military. I was also struck yesterday by what we heard from Admiral John Kirby when he was asked continuously at the briefing room about does this weaken Putin. He didn't want to go there, and he said Putin still maintains a tremendous amount of power. Yes, individuals are speculating that, given the fact that this was the first time really since Putin's rule that we've seen this type of mutiny and rebellion against him. At the end of the day, if you look at what's happening in Russia today, he convened the heads of the top agencies yesterday. He is speaking at the moment to Russian servicemen and military. This is an individual who still maintains a tremendous amount of power, especially when it comes to the Russian military, which John Kirby says all of it is in Ukraine right now.
Anne-Marie, another thing that the U.S. officials said yesterday was that the nuclear threat was not seen as elevated. They did not seem to lean into this idea that this raised the risk of nuclear proliferation or any kind of elevated chance of extraordinary measures taken by Vladimir Putin. Do we have any sense of why they could say this with such assertion?
Well, at the moment, if nothing has changed and Putin is still in power, and they have not changed how they want to assess his nuclear use in the past, that has not changed for what they view it as today. But What I would say is that officials are concerned that given that this is going to obviously mean Putin, who is already very paranoid, becoming more paranoid, there is a potential he doubles down. And analysts suspect this could mean he becomes even more aggressive, and that could potentially use of either nuclear weapons or more violent weapons. But at the moment, the U.S. does not see a need to change their posture. I think there are still a tremendous amount of questions in the United States about what happened this past weekend than answers, and I think that is something the President, Admiral Kirby, were really trying to get at. And the point they really wanted to get across, given the fact of what we heard from Putin in the past, whether or not it was blaming then Secretary of State Hillary Clinton about protests in Russia, whether or not it was blaming the United States about Russian-backed leaders in Ukraine in the past that were ousted, they always blamed the West as meddling in internal affairs. And President Biden really wanted to get ahead of that narrative.
Maria, there's a real question of how Ukraine is going to use this opportunity to potentially make inroads in the conflict, in the war that Russia has been declaring on them. Do we have any sense of how they are going to try to use this to their advantage? Are there any early signs of that?
There's two things. One is obviously the optics of this, and I spoke to a Ukrainian official who said, okay, there was a mutiny, and of course now Vladimir Putin seems to have calmed the situation down, but already it shows, and this is what they insist and have persisted for a year, that Russia is not an invincible country, and that Vladimir Putin is not this all-powerful KGB man. There's a myth to that story, too. To me, the real question now is, if you have Wagner that gets incorporated into the Russian army, and it's Shoigu, and it's the Russian officials that handle this operation, is this a good thing? Because we've seen the reality is that a lot of the heavy fighting was done by Wagner, and there's serious questions as to how the Russian army has handled this situation. On the battlefield, the Ukrainians say if that continues, it could be a competitive advantage. They also repeat it is too early to say whether the counteroffensive is going well or not.
Maria Tadeo, thank you so much. Greatly appreciate it this morning in Brussels. And Anne-Marie Horton in Washington. Look for Balance of Power tonight with Anne-Marie Horton and Joe Matthew as well. Red and green on the screen on the data front. Red and green on the screen and yield as well. 10-year yield flat. I am watching oil. We had a 69 up to 70 level yesterday. We've drifted down $1 all into a 68 handle on West Texas Intermediate, 68.39. Brent crude threatening a 72 handle. We're not there yet, 73.12, down a full $1 on Brent crude. And to triangulate that back to China, renminbi was a 7.24, fractionally stronger, 7.22. I thought Kitchuk's was just brilliant on the noise of foreign exchange forward.
Particularly with the UN. I mean, China's been intervening in a much more significant way as they try to stave off some of the losses. They've been somewhat concerned that their previous efforts didn't work. And this has been a big issue and a big question mark hanging over global markets. And I wonder how much oil is a litmus paper for what people perceive China as having going on versus some larger question on the state of the global economy.
Can we say that Delta Airlines lifted the markets? I think we can possibly allude to that.
Is that a pun?
No, well, you know, up and away. Wait, that's another company. But the answer is NASDAQ up 0.4%, and it wasn't Walgreens Boots that drove the NASDAQ up 0.4%.
Walgreens Boots is not doing so hot. There is this issue, though, where we've seen transportation and airlines in particular continue to just blow it out of the park. They said that they see full year adjusted earnings per share at the high end of $5 to $6. They had seen $5 to $6, but it's sort of giving a sort of guidance given the strong demand from people like myself who are, you know, taking vacation with their kids.
I think 16 lines on the ECO screen says it's a Mike McKee day.
Oh, yeah.
I mean, it's just we haven't really talked about this here at 724 in New York. There's a wall of economic data today.
It's not just housing prices.
Tons.
We get home
Durable
sales at
goods.
10. I'm really curious, actually, to get the Dallas Fed services activity. We got the Dallas Fed manufacturing activity yesterday, and it was really disappointing. This has been something people have been pointing to as a recession warning, one of those indicators everyone ignores. do we get the same kind of downward trend in services, which would indicate not a rolling recession, as you say, but something that is a little bit more consistent and unified in
Well,
its
I'm going to
growth?
look at this. I've never looked at the Dallas Fed Services Index. I'm
This is
sorry.
a shock face.
And the answer is sort of a leveling, and then the pandemic crush, the rebound off the Biden stimulus, and it peaked out the summer of 2021, let's call it 2 years ago, and it's ebbed down. And unfortunately, Bramo, as usual, is correct, and I'm not. If it breaks down from here, it's a big deal.
That's what some people are saying, maybe.
Folks, please stay with us. Team coverage on the Dallas, Texas Service Sector Outlook General Business Series from the Federal Reserve Bank of Dallas. We'll bring that to you only on Surveillance. Futures up 7. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg Surveillance. Good morning, everyone. Jonathan Farrell on assignment. Lisa Bramwitz and Tom Keene holding court in New York. Across the markets, there's some nuance here to a large body of economic data this morning. 10-year yield giving me an nudge, 3.72%. We're going to talk a lot right now about that yield, maybe what it means to the housing market as well. Red and green on the screen. NASDAQ futures up 0.4%, gets my attention. this morning. Lisa, I looked at a bank. It doesn't matter which bank it was. It's in the news. But I looked and I just wanted to see what a CD rate is. And the answer's higher. It was a 13-month CD. And I looked at the yield and I said, oh, money market-like. They've really come up.
They need to, because people are aware and they're not going to go into those CDs, those instruments, unless you get that. And that's going to be the flight that we keep seeing potentially from banks. Can I give you some names?
Yeah, we're going to dive into that. And what do you got? Names?
Walgreens. I want to take a look at Walgreens. Really interesting. Just to sort of reiterate what we've seen there, down almost 7% after slashing its full year forecast for adjusted earnings per share. Also saying that it's because people are spending less on COVID and they got the flu less. And yeah, also people just have less income. What I find interesting is this. This is a profit margin story. Revenue in the first quarter was $35.4 billion, which beat expectations by more than $1 billion. And yet still their earnings per share disappointed. And to me, the margin story is what I'm watching all around.
I don't know what to make of it other than, is it been a challenge? I mean, there's just no other way. It goes back almost 10 years now. Not to equate it with Bed Bath & Beyond, that's inaccurate, and not for the many thousands of people that work at Walgreens, not appropriate. But nevertheless, there's that tinge to it of this is just taking forever.
Well, especially when they're trying to complete the merger, but also gain some headway with respect to cosmetics and such. Delta, you talked about that. They raised their guidance for 2023, and they reiterated guidance for 2024. Also interesting, they said that they expect the free cash flow to total about $3 billion this year, up from $2 billion previously. Those shares up about 0.7%, but they've already gained so much. Tesla is fascinating to me. This is really one of the big bellwethers for the market. Shares up about 1% today. They were down more than 6% yesterday after Goldman Sachs downgraded their recommendation on them. It was the biggest sell-off since April. People gaming out whether Tesla will be the bellwether in terms of not necessarily delivering the expectations that people are looking for with respect to their electric vehicle charging network, as well as just in general the dominance in the EV space.
Let's do this now. Let's go back and swing from the equity markets back to the bond market. As Lisa and I were talking about, there's an adjustment in yield. Somebody fully on board with that. The last time he was on, he was mesmerizing. He's managing director, strategic income with lots of mortgage experience, Eagle Asset Management's James Camp. James, thank you so much for coming back to the show. I'm not going to mince words. You've got that St. Petersburg clarity to your writing, and it's real simple. You are looking for a 4% 10-year yield. What does our world look like if we get a 4% 10-year yield?
Well, Tom, good morning. And Lisa, good morning. It's a slowing economy. And I think the Federal Reserve has basically told us the only way out of the inflation conundrum is to have a recession. And I think we should take them at their word that they're going to continue to push on short-term interest rates, and there will be some follow-on effects with longer-term interest rates to get this economy to slow down. That's really the only way out of the conundrum that we're in with inflation. So I think what happens this summer is we're going to have the lowest CPI print that we have all year in June because of base effects. We've talked about that quite a bit. Those get easier to beat as we move into the July and August months, and the Fed's going to have all of the cover that they need to continue to hike. So we think we probably top out at a 4% 10-year yield. It'll be a big buy for us as fixed income allocation at that point. But that's where we think we hit intermediate term.
I mean, your work in engineering and bringing it over to the dynamics of mortgage security, let me ask an open question. If we get a James Camp world, what does the housing market look like? What do mortgage securities, what do commercial real estate look like?
Well, it's going to be a challenge, right? We really haven't ever replaced the financing model for residential mortgages post-GFC, and we sort of have a cobbled together secondary market for structured product. We also have a banking system now that, although I think the crisis, quote unquote, is behind us, we have very tight credit conditions and we have bank balance sheets that are still under stress. So credit availability in the mortgage side is going to be limited. And I think it's going to show, that the mortgage market is kind of having a little bit of a bounce here. That's pretty typical late cycle stuff. I think mortgage markets and the housing market probably slows in coincidence with the economy slowing down back half of the year.
James, when you talk about this tightening in credit, I think about this Federal Reserve paper that came out over the past couple of days. And in this paper, it said the share of non-financial firms in financial distress has reached a level that is higher than during most previous tightening episodes since the 1970s. Why are we not seeing it in credit valuations? Why are we not seeing it in a more dramatic increase in bankruptcies?
Because it happened so quickly. So because it's 12 months ago, we were at a 1.5% funds rate. The balance sheet was still expanding and M2 was still expanding. I think people need to remember that we're only 12 months into this cycle. It's been a very steep, very abrupt move, and the effects of which, we talk about inverted yield curve, et cetera, they're not going to show up right away. And right now what we're seeing is those things are taking hold in the economy. We're finally getting to a real interest rate that is positive, credit conditions that are really tightening, and the Fed's work is really just starting at this juncture.
We always think about stock traders who talk as though they are bond analysts, and increasingly we are looking at bond strategists as increasingly stock experts with respect to valuations. How much are earnings from some of these companies going to be a tipping point, not just for the equity market, but also bond markets as they look out to possible disappointments that, as we just heard from Stuart Kaiser, might be a real catalyst to the downside?
Lisa, it's a great point. It's why we work hand in glove with our equity counterparts for income and income generation. As you mentioned earlier, there are companies that are pushing top line revenue growth, nominal growth very well because they've had pricing power. Once that pricing power erodes and we're seeing consumers tapping into savings, we're seeing credit card debt go up exponentially. We're seeing the cost of that debt go up. You're going to see the pressure on margin. The sticky part of the inflation story is labor. You don't have somebody come into the office or come into a job at $20 an hour that's going to turn around in return for $15 an hour. So that margin compression is very real. Companies are not going to be able to continue to push price, and the underlying cost structure, we think, has some inertia to it. So margins will come down.
What do you feel? I mean, it's a fixed income chat, but James, I'm going to ask you about the equity market. Do you think it's extended and vulnerable, or are we near a second leg of a bull market?
I think it's unequivocally extended and vulnerable, and I think it goes exactly to the point of where did the growth come from? It wasn't necessarily unit volume. It was the fact that the companies were able to demand, for the first time in decades, higher prices for their goods and services because the consumer was flush. As that consumer works off those excess savings rates, which we're seeing in the data, the underlying cost structure, because of the labor market, is going to continue to put pressure on margins. Look, the labor market has a seat at the table today. This is a different world than pre-COVID. I don't think we're ever going to go back to an environment where labor doesn't have some negotiating and some ability, because of work from home and other dynamics, to really push. And so I think margin pressure is very real, and I think that's where the equity markets are going to begin a correction, probably Q3, Q4 this year.
If the Fed adapts and adjusts to a James Kemp view, what is the asymmetry at 4% on your 10-year yield call? I mean, it could easily blow through 4% given a set of events, right?
It absolutely could, but I do think that the Federal Reserve is going to get what they want. I think they're going to get their recession. I don't think they're going to move off their 2% long-term mandate, which perhaps is unwise, frankly, given the secular changes that we've seen in the economy. But I think ultimately when that happens, you're going to get a reasonably quick about-face in Fed policy. And remember, 2024 is an election year. If we do get the slowdown that we're calling for, Q3, Q4, and we get some unemployment numbers that approach 4.25%, we may be looking at early 2024, early spring of next year with a pretty aggressive about-face in the Fed. And that means that bonds are going to have a tremendous tailwind from a total return standpoint, because they're already starting from the most generous yields we've had in nearly 15 years.
And this is actually increasingly consensus. We have almost a 0.5 percentage point of a rate cutting cycle priced in next year for the first half of the year. James, are you basically saying if we do see that weakness in the equity space, that bonds will once again reprise their inverse correlation with the stock land, and really the 60-40 kind of portfolio arrangement will retain some of its past glory?
Lisa, I 100% agree with that. 2022 is the anomaly. We had correlations across asset classes across the board. Again, it was that abrupt sea change, that regime shift that happened seismically and quickly on the capital markets. And I think the 60-40, the balanced approach, free cash flow from dividends, free cash flow from dividend growth, and the most generous bond yields that we've had make investment in the income space, frankly, as sanguine and as a low vol proposition as we've had in quite a while. And that negative correlation is back.
James Camp, thank you so much. With Eagle Asset Management in Florida. Red and green on the screen here. Camp driving yields lowers 3.72% on the 10-year. I'm kidding there, of course. What I find fascinating about this is what does the Bloomberg Total Return Indexes, plural, do? There's 8, 9, 10 of them. And just to take the blended total return index, price up, yield down has been really challenged here. No one's looking for, as Mr. Camp mentions, lower price, higher yield on a blended basis. Everybody's rationalizing, yeah, for a moment we'll do this. What if it just breaks down again?
We just had the worst sell-off in the bond space ever, right? I mean, yes, last year
ever's the
was
operative word.
an unprecedented year of declines at a time when credit quality still isn't terrible. We did not get a bankruptcy cycle. In fact, Torsten Slok of Apollo Global Management put this out this morning, basically saying that the quality of auto loans and mortgages, not to mention a lot of corporate credit, is a lot better now than it was 10 years ago because of the nature of how things have matured. If that's the case, then you have a ballast there, the equity-like component of credit versus the benchmark question around where we go with rates and longer term inflation expectations.
I would bring it over to who gets not a real wage gain, because you may not get a real wage gain, but gets a better, worse wage gain than many other people in society. I think it's going to be fascinating to see, say 2 years out from now, where real wages end up. Right now, the VIX 14.27, down negative 29 points there. Standard & Poor's 500 we're up fractionally, up 0.2%.
You talk about the labor market, Tom, and to me, this is the mystery of what happens next. KPMG, the story in the FT yesterday, cutting 5% of its workforce because of the slowdown in demand for consulting and other services. We've seen, 11,000 job cuts announced by a lot of the Wall Street banks. Ford announced overnight that they were going to begin cutting jobs today and tomorrow in some of their salaried workers. Yeah, this is all coming as the unemployment rate still remains pretty low. And
percolating on this, folks, is something that it is in the zeitgeist, but I think it's going to be a lot more. Is this a white-collar slowdown? And boy, 74, 75 was not a white-collar slowdown. It was a blue-collar disaster.
People are saying it is. It's a white-collar recession.
It's going to be interesting to see how that is and what percentage of that was just the overhiring within the pandemic.
It's a great point.
And I think that the jury's out on that right now.
I think you're correct, which is the reason why a lot of people aren't necessarily saying this is going to increase the unemployment rate materially.
Quickly, what's my story of the day on the Bloomberg Professional Servers? Bloomberg reports, and this is the wonderful Anya Andrianova on Japan. She picks on T. Rowe Price, Sebastian Page in the House down in Baltimore, and this is on the Bank of Japan. T. Rowe Price says they will surprise, they will finally give way. It is out at a yen of 150. Euro yen is extraordinary. That's what the adults like Kit Jukes look at. Mark McCormick at TD Securities, and you've got Euro yen out to a 157. Not a never level, but in recent history, strong Euro, weak Japan. This bears careful watching. Anya Andrianova with that reporting from Bloomberg. Coming up, we look at commodities. Darwei Kung joins us. This is Bloomberg.
Suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We need to bring inflation down to have sustainable growth, which is why it's super important to do this. This time around, since it's not just a demand phenomenon, we've had supply disruptions correct themselves. We've had energy prices come down. I think both those factors are helping bring inflation down without needing too much of a hit to the economy. But I think we have to wait and see. We're only just seeing the effects of monetary policy work through the system now, and we could see much more slowing.
We will have to wait and see. She sounds like the economist she is. Gita Gopinath, the IMF First Deputy Managing Director. This is from Centra. For our American audience, tough sledding for Francine Lacroix and company. Centra is, think of the movie Frozen, you know, let it go, outside Lisbon. I mean, that's basically what Centra is. It's this gorgeous 18th century, 17th century set of little chateaus and fancy places where fancy people live, and it's where the ECB holds a summer confab. With Lagarde speaking earlier today. Tomorrow, we will give you complete coverage of central bankers showing up with microphones on at Centra. Francine Lacroix leading our coverage there. Of course, look for Francine Lacroix and the Pulse. We'll have that for you from London. On New York time, I believe it's at 4 a.m. New York time. Red and green on the screen right now. And right now we look at commodities. An important study right now, as Lisa Bramwitz is mentioning earlier. Darwei Kung joins us, portfolio manager, head of commodities, DWS, this morning. Darwei, is copper something we should study? I mean, you're the grizzled veteran here. Is copper the commodity to study to get a gauge of China slowdown or growth?
Good morning, Tom. Good to see you again. Copper definitely is very important. It really covers one particular part of the Chinese economy, the industrial part of the Chinese economy. Right now, we're seeing a lot of weakness coming out of that area, and the copper price definitely reflects that. Copper price also reflects the expectation of potential future support from the Chinese government to boost either both the property market or infrastructure or other part of economy that's more pertaining to the manufacturing side, industrial side of Chinese economy. And we do see a lot of weakness on that right now. It's not surprising to see copper price coming back down from $8,600 per ton, given there's been lack of any sort of official communication on that.
Dr. Gopinath just on with us with the IMF, and I'm sure you saw Darwei, their call 10, 12 weeks ago for shockingly tepid global growth out to 2028. If we get an IMF call out to 2028, what does supply and demand dynamics of commodities do? I can't imagine. I don't think we've ever been here.
That's very, very clearly very pessimistic view of the global economy. One thing I would say, though, is even though the demand side clearly would be impacted by that, the supply side is surprisingly disciplined by across the board by various producers, both in the metal side, mining side, as well as on the energy side. We do anticipate very tight capital spending. That's actually been the case for several years now, where mining companies are focusing on paying out the cash flow to investors, to equity investors, rather than trying to come back with large capital projects. So we do anticipate discipline in the production side of commodities. That said, if we actually have very severe negative downturn for growth, clearly we will see surplus across the board for commodities as well.
Darwei, you are among many strategists who got it incorrectly in terms of the incredible demand for crude and the lack of supply on the heels of Russia's war in Ukraine, on the heels of the recovery over in China. As you look into the next 6 months, do you see that this is just a move that's been delayed with prices of crude going up, or do you see this as a new paradigm with a lot of other factors taking away some of the old rationale?
I think one of the things we did not foresee when the war first broke out last year was how much inflationary pressure would trigger the Fed to raise interest rate as aggressively as they did, and what impact that would have to not just U.S. economy, but also global economy. The second part we didn't foresee as well was the response from Chinese government with respect to keeping the economy growing and the determination to turn inward to domestic consumption. And that economic policy shift had dramatic impact on demand for commodities as well. We do see, though, those two factors playing out, not that we don't see any new demand, just the new demand will come slower. So we're anticipating the price to rise from here for oil in particular. By the end of the year, we're anticipating balance to go back into deficit again, and we're anticipating price to go up. Our forecast right now for June of 2024, a year from now, is $87 for Brent and $84 for WTI, higher than where we are spot price and the forward curve as well.
When you talk about demand coming online, Delta came out with their forward projection this morning ahead of their annual shareholder meeting, and it was an increase yet again. The pricing power, incredible. The amount of travel has just blown away all expectations. Why do you say that we're not necessarily seeing that much demand, that we're still seeing the ramifications of a rate hiking cycle that defied a lot of what people thought?
Well, that's a great point. We do see a bifurcation of demand. So if you look at the service PMI, still very strong across the board globally, and demand for both air traffic and ground traffic have been very robust. The actual realized driving data, flight data is above expectation and actually above 2019 level, pre-COVID level. However, if you look at the industrial side, so the heavy vehicle use, industrial production use has been coming down quite a bit. And the manufacturing PMI also reflect the same story. Very negative PMI prints across the board. Only a couple of countries are exceptions, but most other countries are below 50 and significantly below 50 on manufacturing PMI. That has a dragging effect. That's a drag for oil demand. And balance of the two is still positive from our perspective. It's just that, unlike the past years, we're not getting both barrels firing at the same time.
Darwei, one final question. The whole electric vehicle ballet, lithium batteries, what's it going to do to your hydrocarbon world? What is the EV impact, the effect upon Brent demand?
Great question. I think the short term, the impact is actually very limited. China has been the best in terms of adaptation for new vehicle purchase on EVs. So over 3 million vehicles year to date so far. About 30% of the new vehicle sales are EV vehicle. Their target is 100% by 2030. Europe is second, and US is by far the third last amongst the largest buyers of vehicle. With that positive number, it's gone up quite a bit year over year. The growth rate year over year is significant. However, compared to the base of 100 million vehicles outstanding that's on conventional fuel source, I do think that in the near term, we're going to see oil demand to continue to scale to traffic. But by 24, 25, we should start to see some turning points on the traffic. And by 2030, we'll probably see some level of peak for ground transportation demand, and at that point, we'll see the EV part of the transportation to be more dominant compared to the ground transportation.
We got to go longer on this next time. Dari Kung, thank you so much with DW. Asked there on commodities and all the mystery of China as well. Lisa, I haven't done any homework on this other than to say we're focused on who's going to get Tesla recharging on electric stuff. And you got the whole lithium battery disaster in New York City of buildings literally burning down because, you know, there's all these inflammatory stories. But the mother of all stories is if EV really entrenches, what's it do to oil demand? And I really haven't seen a killer study on this.
Well, the AAA study on automobile use in the U.S. came out yesterday, and it indicated that there is a record amount of travel planned and already in effect during this summer season. And yet we're not seeing the translation into record demand for gasoline. That's the issue. With respect to China, how much of that is the story there as well? Given that there's a much more inward look, domestic travel, domestic consumption, there is a much greater adoption of electric vehicles over the nation.
I have to admit, all my radar is up on this. It just sounds like a free lunch. And from a thermodynamic basis, I'm going, I think my course has said this can't be a free lunch.
I think that
we're like free lunching it into 2004. Red and green on the screen right now. Futures up 3. Stay with us. This is Bloomberg Surveillance.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product because these products, these medicines keep people alive.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
inflation is slowing, and by a year from now, inflation will be back down pretty much where the central banks want it to be.
The global economy has held up a lot better in this first half of the year. Inflation has as well.
The core inflation rates, they are coming down, but they're still elevated.
The Fed simply raising rates to a historically still low level is not going to be enough to get inflation under control.
Now, we're not expecting a ton more rate hikes from the Fed, but it does seem like one is likely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The markets seem to be Teflon, even in the face of a hawkish ECB, a hawkish Federal Reserve. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John is on vacation. Tom Keene, we are looking. I know you can't pronounce the V word, vacation, which is what we're looking for.
Ischia, something like that. I can't pronounce where he is.
Honestly, it seems like this market wants to rebound. It had a couple days of sell-off, particularly led by tech stocks.
Agree.
And
totally
agree. Now, it wants to just sort of, are people buying the dip? Was that a dip?
With the dip and what we had with Anne-Marie Horton and Maria Tadeo early here on all that's going on with Mr. Putin, it hasn't affected markets. You were way out front on this, and you see it again with oil, 68.06. Let me get a 67 on West Texas Intermediate, but still the market's resilient.
I feel like people are saying, we can have every existential worry in the book. We have for the past 12 months, 24 months. We're sick of it. If you look on the ground, it looks pretty good. And then, oh, wait, but what about the earnings? Have we built in expectations that are much too high relative to what some of these companies can deliver?
Well, we're going to have to see on the earnings front today. Grimm, Walmart's, Boots Alliance, train wreck for 14 years or whatever it is, 10 years. And Delta Airlines flying away at Bastion, getting it done along with the rest of his business class industry.
And yet Carnival yesterday beat expectations. And then
Carnival
their shares, but their shares then tanked, right? So how much had already been built into the expectations? To me, I wonder if we move beyond this question around hawkish central bank speak, because we have heard from Sintra this morning. Christine Lagarde coming out very hawkish, more hawkish than a lot of people were expecting, saying they're going to raise rates again in July. Their work is not done. This is a real pricing pressure that they cannot help but to continue to fight. Will markets just simply stop responding?
I think we're going to wait for data, and it's going to be the earnings data that you and I have emphasized today, and also as we get to the Fed meeting, what we see with the jobs report. That's got to be, I don't even know when jobs day is. Let's get out. We go to the Bloomberg terminal for this because no one's briefed. The interns, did you notice the interns are weaker this year than last year?
No, absolutely not.
I have 4 interns with me. Good
Disclosure,
morning, Chapel
we don't
Hill.
have interns.
And
so no one's
I have 4 interns with me, and I said, do you all have air conditioning? And only 2 of them had air conditioning. There's 2 of these kids are suffering without air conditioning on the island of Manhattan.
Are you keeping slave labor, Tom?
It's outrageous.
All right.
It's really, really bad. When's the jobs report? I'm trying to get it.
It's the first week. It's the first week in July. We get the June jobs report. We get the on that Friday. I'll get the exact date out for you. I believe it's July 9th. Or maybe, I don't know. I'll check it in a second.
There it is, July 7th.
July 7th, excuse me.
Yeah,
right now, let's take a look at the markets and see what's going on. You are seeing a lift right now. A bit of a reprieve after yesterday's sell-off that was led by the tech names. You're seeing today a bit of a reprisal in the S&P, a little bit less of a gain, about 0.1%. Euro strength, to me, Tom, this is important. Yeah. Getting close to that 110 level, 109.47, after that really hawkish discussion from ECB's Christine Lagarde this morning.
I'm going to triangulate it right over to the new Bank of Japan governor at Centro with Francine Lacroix. And this is a fragility. It's been off our radar with Russia and with all that's going on within economics, finance, and investment. But you know what? Here's the theme. Euro stronger, yen weak. You don't have to know anything else. Yen 143.55. I'm not on the collapse watch, the YCC watch, but we're getting there rapidly.
Especially given the fact that the Japanese economy has been a haven for so many people who keep saying, let's buy Japanese securities. I'm also watching yields grinding higher at the front end around the world, and that yield curve getting that much more inverted, particularly over in Europe, Tom. That's interesting to me.
I'll have to see. There's no other way to look at it as well. Futures up 3 in the Dow and negative 51.
As we look forward, the question around the earnings surprise and whether this is going to be something that becomes a pattern is really the main theme I keep hearing from people. Joining us now to discuss, Cameron Dawson, I'm so pleased to say, Chief Investment Officer at New Edge Wealth. Cameron, how much is that on your radar, that earnings may be the catalyst to the downturn, to the caution that so many people have been warning about?
Yeah, I think it is the important factor because even though we still see a lot of dire economic forecasts, effectively economists have us starting a recession in just a few days in the third quarter, you don't see that in the earnings forecast. You see a big recovery in the back half of the year and then an even bigger recovery into 2024 and 2025, driven by resilient economy and big margin expansion. So that would be the key source of downside surprise if we don't see those earnings materialize. And we're watching the margins really closely because inflation has been actually very good for margins. It's why we think we got to record margins in 21 and early 2022. So as inflation continues to moderate, pricing power moderates, that could put downward pressure on those margins.
You've been cautious for quite a while. Are you getting more cautious or less cautious?
So we've been cautious in expressing it by remaining invested but staying in quality and saying that we don't want to be taking big risks on very cyclical, economic sensitive parts of the market at the same time as not wanting to take risks with things that are more speculative, that really require the boost that you get from central banks easing policy to see their stock prices do really well. What's interesting is that we have seen those stocks lead this year, and that's been one of our biggest surprises, is that you have seen the Fed continue to remain very hawkish, but at the same time, you've been seeing liquidity-sensitive parts of the market lead the charge higher because there has been a huge divergence of yields and valuations.
At New Edge Wealth, how do you respond to people that say, I'm scared stiff, I don't want to participate in the equity market?
Have a long-term perspective and have a plan. Because at the end of the day, we have two things that we need to avoid as financial advisors. We need to keep people from selling at the bottom and buying at the top.
This used to drive Peter Lynch. He would lecture on the giant at Fidelity. He actually went in one day. He was so angry. They actually went into Magellan. This is folks in the heyday of Fidelity Magellan, and he ordered a survey of who bought at the top and at the bottom and sold at the bottom, and it was stunning. The percentages were just stunning on your observation.
And one of the things how we navigate this is by focusing on quality through cycles. Those companies that go down less than they went up in the prior up cycle. And what that leads us to do is not necessarily chase big, huge rallies like we've seen in certain pockets of the market this year, and take kind of a tortoise versus the hare approach. We'll probably get to the same place at the end of the day.
Thank you. Thank you, Tom. I appreciate it. Carry on.
We'll probably get to the same place without having the big wild swings of volatility as you chase to the upside and then see big reversals to the downside.
So here's, I think, the existential question of the year. People are saying it's a recession delayed, not necessarily deterred completely. You're talking about some of the sectors that did really well this year, even in the face of the rate hikes. That will play out just later. When do you say the models are broken and that this is something new, something different at a time when this economy and these markets seem much more resilient to rate hikes than ever before?
That's the key point. And I think that this is a function of 10 plus years of quantitative easing that kept long interest rates down. It allowed people to term out their debt and effectively dulled the power of monetary policy going forward. Because one of the things that you've seen this year is that you're not seeing the impact from higher rates impact consumers or corporations simply because they were able to term out debt and have very long maturities. And so now, as you see rates rise, people kind of shrug simply because there is not that same impact.
Cameron Dawson with us here with New Edge. We will continue, but we do want to bring you the news as it comes from Russia. I believe that, well, we just lost the video moments ago. There was a very short video of a stark, larger room with 4 or 5, I'm going to call them Kremlin officials. I'm making it up, Lisa, as I go. And a lonely Mr. Putin at a podium. And the headline here from Bloomberg, we report Mr. Putin says Russia fully financed the Wagner Group. I don't know what else we're going to get about that. We have to get that in translation. But I would state moments ago a Putin sighting would be at least what we see.
And who is he speaking to? Some reports saying that he's speaking to military personnel, but it raises the mystery around what transpired over the weekend with the Wagner Group that is said to be disbanding today, as Prigozhin, the head of it, heads over to Belarus.
And to Belarus, and that's one of the choice sets here. I believe it's a three-pronged choice set. Join the Russian army, go over to Belarus, and I'm not even sure what the third choice set is. None of them are pleasant to see, I'm sure.
Cameron, I'd love your thoughts on this, because this is something we were talking about yesterday, that markets basically shrugged this off because it was a number of tail risks that you couldn't really price in. Do you have a renewed thought on that?
Our thinking is that unless there is something that keeps Russia from continuing to be able to flood markets with heavily discounted oil, that markets probably will look in the other direction. Because one of the key things that has been bullish for markets is the moderation in oil prices. Part of that is a function of Russia selling so much oil at discounted prices. So if we start to see something that could impact Russia's oil production or their ability to be able to continue to sell, that would be the key upward impact on inflation and thus downward impact on markets.
One more question. Where are you on a 60-40 reallocation here? It's mid-year. I got to reallocate. Do you believe in 60-40?
We believe in 60-40 plus alternatives because there are still fantastic opportunities outside of traditional asset classes where we see dislocations because of all the turmoil of the past couple of years, where we are starting to allocate to things like venture very selectively in private credit. It's a popular place to be, but we are finding great opportunities outside of your traditional assets.
Cameron Dawson, thank you so much. Greatly appreciate it this morning. Red and green on the screen here. Futures up fractionally. I'm going to call it a modest lift with the NASDAQ, not like what we saw 2 hours ago, but nevertheless, the NASDAQ up 0.3%. Lisa, the 10-year yield giving me nothing, 3.72%.
Just to give you some perspective on the NASDAQ, it might be up or indicated up right now, 0.3%. Yesterday, it was down 1.2%. It was a pretty significant sell-off after a couple days of weakness, and people were saying, is this going to be the beginning of something longer? Well, you know, maybe today is people saying this was the dip.
Fractionally, just a tea leaf off the Putin single headline that we saw on Wagner Group, a little bit of strength in dollar ruble as well. In the currency space, I'm going to call it a churn here. The euro 109.49. Standard & Poor's 500, let's call it flat.
Meanwhile, Tom, when you talk about Vladimir Putin, some of the other intel that we're getting, Vladimir Putin saying that Russia averted a civil war and that he basically said that he needed to act clearly and coherently in a difficult situation. Is he rationalizing what he did to an audience of people who are saying, are you creating two sets of standards where you're going to actually allow dissent after years of cracking down?
I'm not going there. I think the speculation is, you know, the good news is on a Tuesday morning in America, the speculation is less than the idiocy of Saturday evening. I mean, that's about all I can give it. I think to speculate here, we just need to see observable FaceTime to see what Lukashenko says, obviously, and Putin. But where's this guy? His Wagner Group guy, like, surfaced?
There have been reports that the jet that he uses left for Belarus, left St. Petersburg for Belarus, either earlier this morning or late last night. Whether he was on it, we don't know. You talk about speculation, Tom. It felt like an imminent potential threat on Sunday, heading into Monday morning.
Oh, yeah, absolutely.
The fact that there's less speculation now is perhaps because people don't necessarily see the imminent threat, so they can forget about it and just not pretend to be experts on it.
Well, certainly that's what the market says. And again, watching oil maybe is the global litmus paper. It's a touch weaker off $1.24 on West Texas Intermediate, 68.13. A breakdown there. It did print 66 for a cup of coffee 2-3 days ago. So it's not near recent lows. And again, I'm watching dollar yen 143 and euro yen a stunning 157 on strong euro weak yen as well. It is a most eventful day coming up. Economic data, lines of economic data. We need translation. Stephen Stanley, Santander. Good morning.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Putin facing the worst challenge of his career, and his best friend on the global stage, Xi Jinping, offered no military support, offered no direct defense. Putin really does not have real friends on the global stage. A lot of people want to buy his oil for cheap. A lot of people prepared to do business with him. Not a lot of people prepared to take any domestic risk to help him.
Ian Bremmer on fire yesterday. I said to someone last night at dinner, and I just said Dr. Bremmer was brutal on the brutality of the Wagner Group. I thought it was a breath of fresh air, Lisa Bramowitz, to have somebody with actual legitimate international chops clear the air and say, this is what this guy's really like.
It's not as if he's the savior and is actually doing anything that is giving anyone any favors. This is someone who has been a war criminal. Question now is, what does this mean for Vladimir Putin? This morning we heard that he was saying that Russia financed the Wagner Group, which goes against what we had been reading earlier, that the Wagner Group financed themselves through some of their other activities.
We'll have to see. And thanks to our team working tirelessly through Saturday and Sunday to give you the show we had yesterday with In Perspective. Julie Norman with us from the University College London earlier today. It's just been really, really quite something. I have a confession to make. Somebody would say to me in international relations, where have you been most wrong? And I didn't get World War I wrong. I didn't even get Pearl Harbor wrong. But boy, with a vengeance, did I get October 4 of 1993 wrong. We are coming up on 30 years ago with the Boris Yeltsin Russian coup. And there were military tanks blowing up what's called the White House in Moscow with really military damage from shelling. And I got that completely wrong. Terry Haynes nailed it right now. He joins us with Pangea Policy on what we get wrong. Terry, what do we risk getting wrong with this uproar in Russia? I was so wrong on Yeltsin. What could I get wrong here on Putin?
Assuming that Putin is an extremist and about to topple, there are a lot of reasons for that. I think one is that what you've got is you've got Prigozhin essentially losing his nerve 100 odd miles outside of Moscow. You've got a situation where there's no obvious alternative to Putin. Thirdly, and I think most importantly, I think the West is not yet absorbing publicly anyway, just what a bad situation it is to have the Wagner people end up in Belarus, the same country that's got a bunch of tactical Russian nukes and borders not only the northern part of Ukraine, but the western, it has a western border with Poland and a north-south border with 2 of the 3 Baltic states. That strikes me as a bad cocktail. So, I don't think by any means done with this yet.
The bad cocktail, Lisa. Black October is one of the phrases the Russians used for 1993. 147 people killed, 437 wounded, and the 10-day conflict bordered on the worst thing in Russia, going back to Lenin. I mean, is this an equivalent? I'm not going to say that, but that's the study right now.
There was a lot of speculation and a lot of historical references over the weekend, Terry. At this point, we're talking now about what Belarus's role in this is. You mentioned that having the Wagner Group there, potentially having Prigozhin, the leader of it, in that nation, represents a risk to Ukraine and elsewhere. What are you looking for to understand what the dynamic of Belarus's role is?
Well, fundamentally, I'm looking for what Wagner is going to be doing and when and where they're going to be doing it. Back in the day, Churchill described Lenin's entry into St. Petersburg as a plague bacillus, and it strikes me that this might be another plague bacillus. If a destabilized Wagner in a supplicant Belarus is now free to try to figure out what pressure points it wants to hit, whether it be bordering on NATO countries or running down to Ukraine, that seems to be a new significant and potentially destabilizing threat. We've seen no evidence yet that that's going to happen, but Putin will use whatever he's got, as everybody knows, and so what he's proposing to get here is kind of a rogue paramilitary running around broadly doing his will. I think this is a worse situation for the West than is commonly understood right now.
Can you elaborate on that, especially given the latest headlines that Vladimir Putin is saying that Russia did fully finance the Wagner Group? Other people have pushed back and said the Wagner Group self-financed, particularly with its activities in Africa. What is Vladimir Putin likely getting at? Do you have more of a sense based on the rhetoric we've heard over the past couple of days?
Well, Putin will say what he'll say. I mean, and part of my admonition here from the top is that everybody, and no offense to the United States and Secretary Blinken, for example, for saying so, but everybody is saying things that are that are trying to put their thumb on the scale and do things that are and say things that might push their own self-interest. So that should be recognized, first of all. Second of all, to your point. What's happening here is, Wagner's been financing Putin as much as anything else or more. I'm sure Putin would like to keep that funding source coming in, not in Africa and elsewhere. So what they're trying to do is put a bigger handle on Wagner. Now, did Putin provide some seed money to get Wagner going all these years ago? Maybe, but I don't think that's relevant to the situation today.
Terry, off the Wall Street Journal work yesterday on intercontinental ballistic missiles. Are we ready to have more American troops on the continent of Europe? Are we prepared to go back to our Ute?
I think we're going to have to, as part of a NATO force, continue to beef up to some extent, and that's one reason why I'm looking at Belarus and the borders with the Baltic states and with Poland. These are not only NATO allies, but these are areas where the United States and NATO troops already exist. Whether it be in Lithuania, Latvia, eastern Poland, protecting what's called the Suwałki Gap, which is the Polish-Lithuanian border that seals off Kaliningrad from the rest of Russia. And Putin may want to probe that. I don't know that I have no evidence to suggest that he will. But as I say, you've got a rogue force running around with nothing better to do. We should watch out.
Terry Haynes, thank you so much, with Pangea here on our international relations. I missed this last night, and Lisa picked up on it, but now we have a detailed printout from Morgan Stanley on the Zentner Amendment. Lisa, why don't you read the paragraph that Bloomberg News had last night from Morgan Stanley?
Yeah, Ellen Zentner of Morgan Stanley coming out. She had previously thought perhaps the Fed was done in terms of rate hikes. Now she says, we now judge that the bar for a July hike is significantly lower than we had initially expected and have added a 25 basis point hike to our policy path. We continue to see a soft landing, staving off rate cuts to next year. This is sort of the key distinction. She talked about about what changed for her, the lower bar for the Fed to raise rates, was the testimony that Jay Powell had last week in front of Congress. The fact that he said it made sense to continue to move rates higher, but at a slower pace. And that's something that we have heard from others as well.
The back end of the note is surprising to me, and this is the acuity that Zentner, Sarah Wolf, and the team do at Morgan Stanley, is they migrate. I mean, the math here is a little mysterious, but all you need to know is on a core basis, in core PCE, they break 4% soonish, like September, which, on a back-to-school basis could be tomorrow. 3.9% Q4 to Q4. We're not mentally prepared for that. I don't think, 3.9 is not 4.1.
Carl Weinberg was talking about this too, that disinflation will accelerate as the year goes on. And we were hearing this earlier as well, that the year-over-year comparisons make it easier to do so. If that happens, are we talking about a soft landing scenario that so many people wrote off as non-acceptable? I don't know. I mean, we've flipped and we flopped to such a degree. Coming up on The Open, we'll carry this conversation forward. Jordan Jackson of JP Morgan joining us, Tony Rodriguez of Nuveen, and Loria Calvasina of RBC, who has some really interesting things to say, in particular about sentiment and where that balance of risk
Where that balance
right
is, and it's like one day the Calvasina world just moonshot, and the next day,
that's pretty much all of us right now.
To get an update on Lori into the end of the year for small caps as well. All in all, the tape deteriorates through the morning, but still NASDAQ up 0.3%. Stay with us. This is Bloomberg Surveillance.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg surveillance on television, on radio, and at 8:29:41. On any given day, there can be one or two data points. Not today. I think there's 27. Only Mike McKee knows the math on that, but we've got to get out here on a Tuesday. Housing data. We're going to talk to Steve Stanley about this here in a moment. A brilliant note on your housing headaches in ownership and rental. But right now, with economic data flooding in, as they say, Michael McKee, head of all of our analysis here. What do we got, Mike?
Well, we've got durable goods orders coming in significantly stronger than anticipated, up 1.7%. The forecast was for a 9/10 fall in durable goods orders.
Ex-Boeing, wow.
It's probably Boeing, but ex-transportation is still strong, up 0.6, and that was expected to be flat. And of course, the number that economists like Steve Stanley watch, the capital goods orders, non-defense, ex-air, also coming in stronger than expected, 0.7% compared to a 1/10 anticipation for that. And then shipments come in at 0.2. That's bang on what was the consensus of economists surveyed by Bloomberg. So right now I'm looking for the revisions. I'm wondering, Tom, there probably is a bit of a market reaction to this, given the fact that we've seen it come in stronger than anticipated, and that maybe helps with that idea of a soft landing.
A little bit of a yield response here. The 10-year yield 3.73%, a little bit higher yield there. Further curve inversion off the disinversion of the last 24 hours. If your head's spinning, stay with me. My head's spinning too, 97 basis points. There's a modest reaction. But Mike, let's sell forward here to your work later this morning. This housing data is actually pretty important today, isn't it?
Well, it's interesting because new home sales are only about 15% of overall home sales, but there's no homes for sale on the existing side. I was down in Florida yesterday talking with a real estate agent about that, and there's just nothing available. So prices are rising on that side, offsetting some of the damage that's done by the Fed raising rates. But new home sales, there's a big backup in new home sales. We know that builders went into the apartment building business after the great financial crisis because nobody wanted to own homes at that point. And we're short on homes. There's big backlogs for the builders. So we see contributions so far from new home construction to the overall economy. And we'll continue to watch that to see what we get.
Right now, and we're going to stop here, and for all of you, frankly, worldwide, but certainly across America, Stephen Stanley is known to write very dense, acute notes. With Santander U.S. Capital Markets, he's outdone himself with a mid-year review of our housing market. I'm just going to start with one observation. Stephen, congratulations on this superb note of clarity. New home sales were 10, and now they're 14% of the market. New home sales are up 40% is the size of the market in this crazy pandemic we're in. It's completely unusual, right?
It is, and as Mike said, I mean, it's really, I think the genesis here is the backup in mortgage rates, right? Because if you own a home, you're sitting on a 3% mortgage, and all of a sudden mortgage rates are at 7%, your bar to moving is much higher. If you have to move, you move, but if you don't have to move, you stay.
When does that break? What is the catalyst that Santander sees out there that will change the odd housing market Mike McKee just saw in Florida?
Yeah, I think it's just going to take time for people to get used to higher rates. I think we're starting to see that a little bit in terms of the new home market. You know, there was a period of time last year when people were just stepping back and saying, I'm not going to buy a home right now because mortgage rates are too high. And I think now people are realizing that maybe this is the new normal. So you still have this dynamic of people who are locked in with a low mortgage are less likely to move, and that is to the benefit of the builders. So it allows the builders to kind of rejigger their businesses, get their inventories in line, and you're starting to see a little bit of a pickup on the new home side, which is great because in the second half of last year, housing activity was falling at a 25% annualized clip. It was subtracting more than a full percentage point from GDP. All of a sudden in the first quarter, it was down 5%. So still negative, but only subtracting 0.2 from GDP. It makes a big difference.
The overall economy, and I'm going to look at this from the point of view of the durable goods orders we just got out now, has been sort of driven by consumers, and we've watched manufacturing pull back. But this is a relatively strong report. I've been going through it, and interestingly enough, a big drop in defense orders, because that's a huge rise last month.
Right.
But overall, it doesn't seem to be much outside of cars and Boeing. What is the outlook for companies? If consumers are hanging in there, do they turn around and say, maybe we better refill our stockpiles?
So I think what we've seen over the last 3 to 6 months has been a bit of a breather on that front. Business investment in equipment was quite strong from the early days of the pandemic, much to the surprise of everyone. I think everybody thought there'd be a big adjustment there, and it turned out to be pretty brief. And then we saw strength throughout 2021 and into 2022. And the last few quarters have been softer. But as you mentioned earlier, we had a good number in April and now another good number in May for the core capital goods order. So it feels like maybe things are getting back on track. So my favorite manufacturing indicator is the ISM survey, and I think it gives a lot of color on what's going on. And that's been really interesting, because what it's shown is that there's kind of a division of opinion amongst manufacturers, and it depends, of course, on what sector you're in. But about half of them felt like we were going to get weak first quarter activity because people were just adjusting inventories and getting back into line, and the other half was more worried about a more persistent decline. It feels like maybe the first camp, there was some validity to what the first camp was thinking if you're looking at these orders numbers coming back in the last couple of months.
Well, are you optimistic then about GDP for the rest of the year? A lot of people are still thinking we're going into recession in the third or fourth quarter.
Yeah, no, it feels like the consensus call on the economy for the last, 12 to 18 months has been we're going to get a recession next quarter. And the date just keeps getting pushed back further and further. And, I noticed the latest Bloomberg monthly survey of economists, it got pushed back another quarter from Q3 to Q4.
It's worked out.
Yeah, but I've been all along, I've been of the view that the economy was going to prove more resilient, and it has, and I think it will continue to do so. But if you look at GDP, if you look at the components right now, it's an interesting mix, because you do have areas of weakness. We talked about housing, we talked about business investment and equipment, but at the same time, not only is the consumer strong, you've got good government spending, because state and local governments are still spending, their excess cash. Right. You've got a boom in construction and like manufacturing facilities. Part of it is the chips sector, but even more broadly than that. So there's a lot of cross currents right now.
If you and I were sitting in Davos on a panel, and Anna Boten was out in the audience, she'd raise her hand and say, "Mr. Stanley, you work for me. I have a question." And we would take Anna Boten's question.
Absolutely.
And she would say, "What is the technology overlay right now on the two Americas out there?" Mike McKee's been brilliant about this for 20 years. There's an America out there that's getting crushed. And there's an America that's technology driven, frankly, like a lot of the Spanish economy. I mean, it's technology to the fore, isn't it?
It is, and I think of course, the latest flavor is AI. And I think the concern there amongst a lot of people is that AI is now threatening jobs of people who before were on the right side of that divide, right? So, 10, 20 years ago, it was all about using technology to become more efficient in terms of like blue collar labor. And now all of a sudden the professionals are at risk. So that'll be interesting. I mean, I will say, just thinking very broadly, this argument has been around certainly as long as I've been doing this, that technology was going to steal jobs, and there weren't going to be job opportunities. And they always, yes, they do take away jobs in some areas, but they always add jobs in other plases. I mean, look, the unemployment rate's 3.5%. So the economy is evolving. Workers need to be dynamic and be able to, segue into different fields, but the economy always seems to create new opportunities.
Mike, where are we in September? We come out of Labor Day. We come out of Jackson Hole. We got a Fed meeting. Ellen Zentner says she's changed her mind. They are going to lift rates here in July. How do you perceive this for say, September 10th, just to pick a date?
I would argue that I have no idea. I mean,
Thank you. That's the surveillance way.
Just doing the math alone, if the numbers continue like this, it would be very hard to get a recession mathematically. And Steve, I wonder then, everybody talks about the possibility of soft landing. How would you define it, and when would you declare it if you were the Fed chairman? I go back to the Vietnam War and Senator Aiken of Vermont, who said we should just declare victory and go home. Does Jay Powell get to declare victory and go home?
No, and this is the problem with this analogy, is that the economy never really lands. Right. So, we talked coming into the year, that was the first question everyone wanted to ask. Is it going to be a hard landing or a soft landing? And that presumes that we're playing a game with a specific end date. Right. Is the economy in recession at June 30th or not? And if it's not, that's a soft landing. Well, the economy doesn't land. It keeps going. So if we continue to see growth, I would say, probably a little bit on the subpar side, but still well above zero. To me, that's not a landing at all, really. If the Fed has to keep tightening, eventually the economy is likely to crack, but we're not there yet.
Jonathan Miller Samuel, new high rents in Manhattan, and yet people like you are telling me we have rent disinflation. Update us on that.
So
nationally, we do.
We're about to get a new reading on home prices, and it's been interesting because just when it looked like home prices were going to fall, they've rebounded. And I think you're seeing a little bit of the same thing on the rent side, where what we were expecting was really more of a correction than a decline. It certainly wasn't a bust, but home prices and rents went up so much in the last 2 years that there was a presumption, well, they've got to come down somewhat. And they came down for a few months, and now all of a sudden it looks like they're rising again. So it's just a testament to how strong the economy is, how liquid households are. And it's a strong market.
Steve Stanley, thank you so much. With Santander, the chief U.S. economist, this morning. I got to sell forward here. What are you going to be doing at Case-Shiller 9 a.m.? Where are you in the Bloomberg world at 9 a.m.?
I will be with your co-anchor, Lisa Abramowitz, who's filling in for your co-anchor, John Farrell. That sounds a bit like Russia. Russia invading Russia to free Russia from
There's not
Lisa filling in for John.
We have not had a Pharaoh sighting yet. He's on one of the unpronounceable islands over in Italy on a well-deserved assignment as well. What we've got is a nice lift to the market. Standard & Poor's 500 up 0.2%. And we say good morning here, Michael McKee and Tom Keene. Lisa Bramwitz, as Mike says, getting ready for the 9 o'clock hour. Pharaohs, I mispronounced it. I butchered it. I said Ischia, and oh my word. Thank you to our global audience for straightening out the ugly American. Ischia, I think is how they... you've been there, no doubt.
Yeah,
I need to get a life. Mike, I want to talk about what we saw in adjustments today from Ellen Zentner at Morgan Stanley. Do you anticipate lots of mid-year adjustments by economists as they get out front of the July and then the September meeting?
Well, I think the adjustments may come more slowly. There are people who just want to jump on a bandwagon. But if you're watching the data, it's going to be about, do the inflation numbers and the jobs numbers come in as the Fed expects? And I think the jobs numbers could be a real key.
July 7th.
If we get a big increase in unemployment like we did last month, then that raises questions about whether they need to tighten more or not. They seem to want to, so I would bet that they will. But at this point, they're still somewhat data dependent, and so when you're making a call, you're suggesting the numbers will come in as the Fed expects.
I have a sentimental bias at 9 a.m. here, folks, in 20 minutes to the work of Robert Shiller of Yale University and someone truly iconic in American economics, Carl Case at Wellesley, in what they did with the Case-Shiller Index, the S&P CoreLogic. It's a Case-Shiller Index. Mike, it's an important data point today of flatness, isn't it?
Well, it'll be something that economists are watching because they want to see where home prices are going and how that's going to affect those inflation numbers we care about. We also get new home sales at 10, and that has a price component to it as well.
And the economist Bramo says she's riveted to the Dallas Fed Services Activity Index. I'm not. This is Bloomberg. Good morning.
For the first, call it 18 years at Chipotle, This was, you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think it's going to be probably a softer landing in that camp. And the Fed, in its statement, while it did not increase rates, was relatively hawkish because they added the potential of having one more 50 basis point increase later this year. But the markets have not quite bought into that.
The right person at the right time. That must mean it's a conversation with David Rubenstein. Afsana Beschloss is one of my favorite people in the world. She is prodigious in knowledge of international hydrocarbons. This is exceptionally well timed. From Rock Creek, Afsana Beschloss with David Rubenstein. Look for that tonight at 9 p.m. An important conversation, and in hindsight, even more important given the uproar that we see in Russia, Belarus, and Ukraine. He is with the Carlyle Group. David Rubenstein joins us this morning. David, I literally got goosebumps. She is just the perfect person to talk to. Tell us what Ms. Beschloss brings to the table.
For those who don't know, Afsana Beschloss is an immigrant from Iran. She was educated at Oxford. She was the treasurer and chief investment officer of the World Bank, and subsequently started her own firm called Rock Creek, which is now probably the largest woman-owned investment firm in the United States, certainly the largest woman-owned firm by a woman who's an immigrant, managing about $17 billion. Afsana is involved in a lot of philanthropic activities as well, on the board of the Council on Foreign Relations, Rockefeller Foundation, chairman of the PBS board, and so forth, PBS Foundation board. And she's really very insightful about where the economy is going, because she's investing this $17 billion on a daily basis. She's really actively involved in the markets. And she has a very good knowledge as well about the energy world, because that was what she first studied when she was at Oxford.
I'll say she's really quite good at it, in conversation after conversation over the years. David Rubenstein, just in the last 24 hours, we've seen Lawrence Fink, I believe over in China with the World Economic Forum, not backtracking, but finessing the new ESG message. To me, Dr. Beschloss is hugely focused on the realities of hydrocarbon. What were her thoughts on climate change and on this recalibration of ESG?
Well, her view is that the energy transition is underway. Obviously, it's not going to be happening overnight. On ESG, she's been a big believer in ESG and is very focused on it. Clearly, there's pushback now, but in the end, I think it's trying to, put your finger in a dike, trying to stop ESG from coming forward. Many people around the world are not as worried about the politics of ESG as many people in the United States might be. And as a result, you're seeing in Europe and other parts of the world a real concern about ESG and the need to be more sensitive to environmental concerns. And Afsana reflects that because she's really a global citizen in many ways. She's lived in many different places and invests all over the world.
She's in Washington, as are you. It's a cutthroat job environment. What is the distinction of Rock Creek and their shop as they try to keep, find, and retain outstanding women employees and managers?
The firm has about 50% of its investment professionals and employees are women. There aren't that many investment firms with that higher percentage of that size. It's a very large firm at this point, managing, as I mentioned, $17 billion. So it's been a bit of a struggle, I would say, to be an immigrant and to be a woman trying to build a firm like that. I've known her for a while, and briefly she worked at Carlyle, I should say, and before she started her own independent firm. And I would say that she's known to many people around the world for being very smart, very articulate, and very conscious about the importance of ESG. I should also note, for those people that recognize the last name, her husband is Michael Beschloss, who's the distinguished presidential historian.
Oh, he's not only a distinguished presidential historian, but David, let's be clear, her husband has kept Twitter sane here in all the uproar. He's a national institution with informing the public of presidential history out on at Twitter. I look, David, at where we are right now, and I want to speak to you with your public service to the nation and the Carter administration, but almost a nation starving off the recent NBC poll for some form of middle ground or moderate politics from both parties. How do you perceive that the moderate voice, maybe what Agnew would call the silent America, how do they find their voice in this crazy presidential campaign to come, both Republican and Democrat?
Well, that's a very fair and very difficult question to answer. Politicians typically raise their money from the far left and the far right. It's very difficult to raise money saying, I'm going to be right down the middle, I'm going to balance the left and the right, I'm going to come up with a good compromise that everybody should be pleased with. That doesn't raise a lot of money, and as we know in politics, money is very important. People are spending all their time raising money in Washington, D.C. So the moderate voice is very difficult to prevail. Hopefully, we'll have more moderate voices. Last night, for example, I interviewed somebody that some may not say is moderate, but at the 92nd Street Y in New York, I interviewed Liz Cheney. Now, clearly people on the right side of the spectrum would say she's not moderate. People on the left side would say, well, she was very conservative. Now she's doing good public service kinds of things. But whatever you think of Liz Cheney, finding people down the middle that people on the left and the right can agree on is very, very difficult. And I would say it's the biggest challenge that we have in our presidential campaign is how do you get your head above water and get some attention unless you get something done on the far right or the far left, which gets the attention. Coming down the middle doesn't get much attention.
Well, Ronald, I'm going to suggest, and I defer to you, David, but Ronald Reagan codified this process. There's just no question Ronald Reagan was the one, literally as an FDR Democrat in his childhood, came over the Republicans, grabbed the right, and moved to the center. Is that process dead?
Well, Ronald Reagan was seen as being on the far right, more on the right than his competitor at the time, Gerald Ford. But ultimately, the far right became the center. And so today, Ronald Reagan would not be seen on the far right. Donald Trump might be seen on the far right, but not Ronald Reagan. But Reagan is somebody who, had a way to communicate that was great compared to other politicians. He was called the great communicator for a good reason. And even though I was not his political supporter, I like to quote him from time to time. And my favorite Ronald Reagan quote is, the most dangerous words in the English language are, I'm from the federal government, I'm here to help you.
Well, I think that there's a little bit of that going on based on the zeitgeist right now. David, let us bring it back to hydrocarbon here and Dr. Beschloss. What's her view on a barrel of oil out 1 year or a Rock Creek 3 years?
Well, as a general rule, if you ask the CEO of an energy company where oil price is going to be in a month or a year, they will laugh because nobody can really know. At the moment, given the uncertainties in Russia, I suspect oil will drift up for a while. And as the Saudis seem to be trying to be in a month or a year, they will laugh because nobody can really know. At the moment, given the uncertainties in Russia, I suspect oil will drift up for a while. And as the Saudis seem to be trying to cut down production a bit. I suspect there'll be a further drift up. But again, I don't see $100 oil anytime in the near future. But I do think you'll probably see it drift up from the high 60s to the low 70s in the not too distant future.
David, thank you so much for the generous time today. David Rubenstein of the Carlyle Group, but far more with these conversations for Bloomberg. You can see them, of course, on Bloomberg Television tonight. Afsana Breshlosh of Rock Creek here on Bloomberg Wealth, but also on our wonderful digital platform. And in YouTube, we're really sprucing that up. I'm really happy with the headway we're making out on YouTube to get these interviews and the conversation out as well. It's been an extraordinary day. I'm going to dovetail it, as Lisa Abramowitz said, with the Zentner call on a rate rise, I should say, at the July meeting, and over to all that we've seen from Russia in some of the little drabs. For example, the Putin speech this morning, I'm going to say it was 6 minutes, plus or minus 2 or 3 minutes. These little small windows that someone like Maria Tadeo has to try to interpret where are we on a Tuesday afternoon. I'm going to call it 4 p.m. in Moscow and over to Belarus and Ukraine as well. We'll have to see how that plays out into the evening as best we can. What you need to know, economic data coming up. We like the data that we saw here at 8:30 with Michael McKee. NASDAQ 100 up 0.4%, SPX up, Dow slightly red. The yields are just a mess. There's no other way to put it. Curve inversions improved, less inverted over the last 24 hours. I'm going to call that 95 basis points on the 210 spread. But coming up, as we heard from Stephen Stanley, critical housing data. Stephen Stanley's note from Santander, please get that from the bank. We protect the copyright of our guests. But boy, I'll tell you, it is a tour de force on the housing economics, ownership, and rent that we have right now. And the summary for Stephen Stanley is there just seems to be a brighter horizon out there for housing. Can you imagine that with a mortgage rate of 7.25 or 7.50? I can't get my head around that. Stephen Stanley of Santander on the housing market, just brilliant to say the least. On the dollar, slight dollar weakness this morning. And for David Rubenstein, West Texas, 68.58. Good morning.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. We do see a more constructive tone after yesterday's 1.2% sell-off in the NASDAQ. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
Coming up, all eyes on Portugal as global central bankers meet in Sintra. The ECB ramping up its hawkish tone ahead of Chair Powell as big tech bounces after its biggest two-day slump since March. We begin with the big issue, climbing the wall of worry.
We have kind of a series of rolling challenges and headwinds.
It isn't a comfortable market.
You're seeing these cracks
under the surface.
Rising geopolitical risks.
Inflation is still elevated. Central banks have seemingly become more hawkish.
More and more hawkish.
It does start to bite.
Recession risks are rising.
The recession risk is fairly high.
Many investors are looking past the turmoil.
This has been an incredibly resilient market.
Extremely resilient.
We're probably at one of those precipices right now where we're peaking in optimism.
The optimism may be overstated.
It's hard to be really positive looking forward.
These kind of recessionary headwinds are going to catch up with us.
Joining us now to weigh in is JP Morgan's Jordan Jackson and Tony Rodriguez of Nuveen. Jordan, we just heard all of those skeptics about the wall of worry and how markets just are completely resilient in the face of them. Do you think we're heading toward a tipping point?
I think we are. I do anticipate a bit of a volatility over the markets. The reality is the recession is delayed but not denied. All of the reliable leading indicators continue to point to recession. When I look at the Conference Board's measure of CEO confidence, that's in the second quarter that hit 87% of respondents believe that a recession will materialize over the next 12 to 18 months. That is very little change from the same reading in the fourth quarter of last year. That was 85%. And so, again, I think businesses are preparing for that recession. The big question is going to be where the recession comes from. It seems like this is going to be very much more of a business-driven recession, maybe less so the consumer. And I think that keeps the recession relatively shallow if one were to occur. But, again, we're seeing a lot of evidence of some slowing in labor markets, weakening in the disinflation narrative beginning to feed through. And so I do think we're a little bit optimistic in terms of equity valuations right now.
Tony, are we heading into some sort of tipping point downward, or do you think that there is resilience that can keep going?
Well, good morning, Lisa. Good to be with you. So I say that it's a really combination. We do think that the economy is going to be more resilient than in typical slowing environments that we've seen in the past. And that's why our base case is that we're expecting to see a mild, shallow recession early in 24. Essentially, the idea is that a lot of the lagged effect of the tightening is going to begin to kick in. We think that tighter bank lending conditions are going to begin to kick in a little bit more in the second half. Consumers will finally get through all of their excess savings, and all that's going to lead to much more moderate growth, slower growth, eventually in our base case, a mild recession. But the point is that we don't expect to see a long, deep recession due primarily to the strength that we do see in the consumer balance sheet right now, employment markets, which, while we think they're going to weaken, will remain historically strong, and corporate balance sheets that are also in fairly good shape as we head into this slowdown period. So the market's a little bit optimistic right now in our minds, but we're definitely not expecting a very hard landing.
The key question for a lot of people has been what the Fed will do, what the ECB will do. We got a glimpse of the ECB earlier this morning, very hawkish. Morgan Stanley's Ellen Zentner overnight revising her outlook for the Fed's path ahead, writing, quote, "We now think that the Fed will hike in July. Our data forecasts have not changed, but our perception of the Fed's reaction function now points to a significantly lower bar to hike." In other words, we would need very weak data prints to convince the FOMC that its forecasts are wrong by the July meeting. Tony, do you agree with this? Is that your sense that right now, if the Fed has its way and nothing shocking happens, it's going to hike rates in July and keep them there for a very long time?
Absolutely. I mean, our base case is that you will see a July hike. We do think the bar is very low for that. However, as we move forward through the year, we do think that we'll begin to see that slowdown in both the growth data and moderation in the inflation data. And that could allow the Fed to just remain on hold with this one additional hike for the balance of the year. Now, if the data proves to be more resilient, inflation a little tougher to defeat here, as it has been so far in the first half of the year, then we could see one additional hike either at the September or the November meeting. But again, our base case would be that it's July and on hold for the balance of the year.
Jordan, if that's the case, how is the situation for bonds constructive, which is, I know, something that you've been talking about and many others would agree? How much have they priced in rates remaining around 5.5% for a prolonged period of time?
Well, a July hike is pretty much priced in. The challenge is when you look at the year-end Fed funds futures in the overnight swap market, it's right at about 5.25%. So markets are still, if the Fed gets 2 more hikes in, they're certainly pricing in some more aggressive cuts. I don't think they get 2 more hikes in. I'm much more in Tony's camp. I do think they go in July and then have to remain on pause thereafter. But I think bonds are going to high-quality core fixed income, I think, is going to outperform equities over the next 3 to 6 months. When I look at the tail risks, do I think the equity market's going to continue to rally to 4,500 in the face of a more hawkish Fed? Probably not. But do I do think the Fed is at the, let's say, top of the 9th inning of a 9-inning rate hiking cycle? Yes, I do. And we're going to see signs, as Tony highlighted, that growth is going to be coming down. Inflation is going to be coming down. I think at the June inflation print, we're calling for a 3.2% year-over-year headline inflation number. That's some significant disinflation from the peak 9% year-over-year run rate in June of last year. I think you put lower inflation, lower growth, the Fed very close to being done. They're probably going to have to make a roundabout and start cutting rates potentially as soon as December, but certainly we think by the first quarter of next year. That all suggests lower bond yields, higher bond prices. It was interesting to see even after the hawkish FOMC meeting, you didn't see much movements in the 10-year. Right. And so when I think about the upside pressure, unless you get a significant recalibration in R-star, or the neutral Fed funds rate, then I don't think you see another big move higher in long rates. I think, again, long rates are biased lower here. And that's, again, why I think I'm still more defensive and overweight fixed income now relative to equities.
And perhaps some of this story is that if the Fed does remain on hold and then even cuts rates, it comes in the heels of real weakness, potentially, that we see through earnings. Goldman Sachs' Peter Oppenheimer weighing in on the outlook for stocks with relation to the profit outlook, saying, well, we do not expect a recession. The outlook for profit growth remains subdued. We expect virtually no profit growth this year and mid-single-digit growth rates next year. The combination of high valuations and relatively slow profit growth implies a positive, albeit moderate, return for equities. Tony, I know your remit is really on the fixed income side, but how much do you see that this is the only logical solution, that if the Fed does pause or even cut rates and gives some wind to bonds, that means that the situation for profits in companies is going to be quite negative?
Well, we do agree with that forecast, and we think we're going to see profits slow down here as we move into the second half. We're expecting to see downward earnings revisions. Certainly, companies are going to hold on to some optimism here in the middle of the year. But as we get into the late third quarter, early fourth quarter, I think that's when companies will finally have to face the facts that margin pressures are going to increase in our minds. Pricing power is declining, we believe. So we do think we're going to see some slowdown in earnings, and that's going to be challenging for the equity market given the levels that we're at. And of course, in that context, as Jordan pointed out, we think fixed income returns are going to look very attractive because we agree with Jordan that we do think that rates here have peaked. while we may see some upward pressure in the near term, as we get to the end of this year, our forecast would be that you'd see a 10-year down closer to 3.25%, maybe a range of 3.25 to 3.5. So that additional tailwind of fixed income returns, we think, positions them, along with their very high starting yields here, to provide pretty attractive returns relative to the equity market through the next 6 to 12 months.
Meanwhile, markets are nearing the end of the first half of this year. The NASDAQ 100 is heading for its best opening 6 months to a year on record, but is it running out of steam? Joining us now is Bloomberg's Katie Greifeld with a look at what's next. Katie.
Well, the NASDAQ 100 up about 35% this year, among its best starts ever, like you say, and completely erasing last year's 33% drop, and a performance that really no one expected. Remember, at the start of this year, strategists were expecting a pretty much flat market. So the burning question now becomes, where do we go from here? You have the bears on one side saying that interest rates are heading higher from here, and thanks to AI's craze, you have just a handful of stocks that are pretty richly valued at this point leading this rally. Of course, you're thinking Apple, Microsoft, and NVIDIA. On the other side of the trade, though, you have the bulls saying that this rally, it's starting to broaden out a little bit. You do have tech, of course, driving the bulk of it, but you also have sectors such as industrials, such as materials that are starting to join in, and that's typically a pretty good sign. And at the same time, you also have the earnings outlook, specifically when it comes to profits, starting to pick up a little bit from here. So that's the debate as we head into this second half, Lisa, and we'll see who wins out.
Katie, thank you so much. Jordan Jackson and Tony Rodriguez, both still with us, both agreeing that bonds are the place to be and that there is going to be a rally. Big tech on the heels of that is still a big question. Jordan, do you think that big tech will continue to rally? Do you think that it's poised to sell off more materially? Or do you think that it will fade into the background as less of a market driver than it has been during the first 6 months of the year?
Well, the big challenge with tech is that given its large weight in the index, it's always going to be driving the market to some degree. But I think the outlook going forward is probably more sideways to potentially a bit of volatility, maybe a bit of a correction in big tech. You know, the reason is, and even when we look at the earnings, it's been interesting. Over the course of May and June, you've actually seen net upward revisions for next 12 months earnings. And I think a big piece of that is markets are starting to look ahead to 2024. They're starting to look ahead towards a period in which the Fed is cutting rates, potentially trying to save the economy from a recession. And so I think obviously the AI craze today, potentially those earnings begin to materialize sometime next year. I mean, all that's sort of, I think, driving, helping to drive big tech higher. But importantly, earnings do not contract across sectors at the same time. I think tech, certainly big tech, you could argue their earnings recession was at the tail end of last year, beginning of this year. They've done a good job in fighting, protecting the bottom line, trying to keep those margins firm. And in that environment, we could actually see, tech keeping the earnings outlook, fairly robust. Again, given that they've done a lot of protecting of margins and still exhibit a bit of pricing power today. So that's why I think, you don't see a big collapse in tech shares.
Well, and to build on that, and Tony, I'd love you to weigh in. There's this question about how important earnings are this particular year. Are we seeing this as the data that is most important to watch, more than economic data, to really indicate the next phase of market development?
Well, you make a very good point, Lisa. I do think that earnings for this balance of this year are going to be important, given the run that we've had and given where valuations are. And what I do think will happen is that there'll be some support against seeing any kind of significant bear market because of the outlook for 24. When you're in an environment where the Fed potentially having to cut rates, where long-term rates, as I mentioned, we think have peaked, so they no longer are a big headwind for equity valuations, that's when I think you can see a more stable market in 24 with earnings that finally settle in and begin to increase in 24 versus our expectation for 23. But when you think about the challenges from last year of rapidly rising rates, growth challenges, a lot of that's in our rearview mirror. And with the outlook for AI in the tech space in particular, we do think that there's some upside to stocks as we look out into 24, but a more challenging environment as we move through the balance of this year.
Tony Rodriguez, Jordan Jackson, both of you are sticking with us. Right now, let's take a look at the stocks moving ahead of the opening bell. Here is our own Abigail Doolittle. Abby.
Well, Lisa, it appears that the S&P 500 is trying to lose its worst six-day losing streak going back to the end of April. We do have some stocks popping higher. The future's up ever so slightly, helping out. Meta Platforms up 1.4%. This after Citi set a street high price target of $360. That represents about 27% upside potential from current levels. They also it's their top sector pick, and they raised their 2024 ad revenue projections. The stock ahead of this raise, Lisa, as you know, up sharply, up 131% on the year. Snowflake up 3.8% ahead of day 2 of Snowflake Summit 2023, reversing yesterday's session losses. The company has announced, you guessed it, an AI-related partnership with NVIDIA, has the stock popping. Walgreens to the downside, though, really plunging down 8.7%, a messy situation. They missed the adjusted earnings by 6%. Sales, there was a small beat, but as you know, Lisa, they cut their full-year adjusted earnings forecast, and it appears to have to do with a slowdown in COVID products, along with, and this is a good thing, I guess, for the American public, less lung problems, but it seems like healthier people not helping out Walgreens.
Abigail, thank you. It is true. We should all cheer the fact that perhaps people are having less viral issues. Coming up, all eyes on the ECB forum in Portugal.
It is unlikely that in the near future, the central bank will be able to state with full confidence that the peak rates have indeed been reached.
ECB President Christine Lagarde kicking things off with Fed Chair Powell on deck tomorrow. That conversation coming up next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
It is unlikely that in the near future, the central bank will be able to state with full confidence that the peak rates have indeed been reached. Bearing a material change to our expectations for inflation, we will continue to increase rates in July.
Central bankers gathering in Sintra, Portugal for the ECB's annual retreat. The main event coming tomorrow with the heads of the Bank of England, European Central Bank, Federal Reserve, and the Bank of Japan all set to speak. Joining us now is Bloomberg's Michael McKee. So far, it has been a hawkish tone from Christine Lagarde. What are we expecting tomorrow?
Well, probably more hawkishness, but a little bit more on the side of the Federal Reserve's outlook that we're going to see higher for longer. Now, here's what Christine Lagarde had to say that hasn't gotten as much publicity as her line about raising rates in July. Faced with a more persistent inflation process, we need a more persistent policy, one that not only produces sufficient tightening today, but also maintains restrictive conditions until we can be confident the second phase of the inflation process has been resolved. So she's telling the Europeans higher for longer, like Jay Powell. Now, the question is what the Bank of Japan will say. But Christine Lagarde has a problem that Jay Powell doesn't necessarily have, and that is the fact that she's dealing with 19 different countries that have different inflation rates. Germany is the so-called sick man of Europe right now. They're looking at inflation that is running at a higher rate recently than it has been, 6.3%. But look what they're expecting for Spain during the month of June, 1.7% below the ECB's target. So although core inflation is still running hot in Spain, you can imagine that there are divisions arising at the ECB. It also comes down, Lisa, to fateful Friday because everybody's looking at the inflation forecast, and unfortunately the four central bank presidents won't be having these in hand before they get to their speech tomorrow. But the Eurozone expected to fall a little bit, even if Germany is rising. US PCE expected to drop below 4%, but look at Japan. They're expected to go up. Now, that's what they want. So we're going to have some discordant central bank views, I think, tomorrow. And of course, the Bank of England is pretty much set on the course of having to raise rates with inflation as high as it is there. But it will be interesting to listen to. But I think the main message for everybody is basically our current policy for longer.
Michael McKee, thank you so much. I'm looking right now, I was distracted at looking at the Japanese yen versus the euro, and you can see just incredible weakness there on the heels of that divergence. Jordan Jackson and Tony Rodriguez are back with us. And as we do hear some of the divergent monetary policies around the world, Jordan, is your sense that the U.S. is a better or worse valuation just on a sort of currency basis than what we're seeing over in Europe?
Well, I do think that the value of the dollar is probably too high. I mean, the dollar came into the year still elevated. Obviously, we've seen a bit of weakness over the course of the year, but again, it's still quite high. When we look at interest rate differentials going forward, if the ECB, the Bank of England are still talking hawkish and maybe have a little bit more work to do than that of the Fed, we probably could still see a bit of dollar weakness relative to the euro. Also, the outlook, I would say, for the euro area, given their, I would say, heroic efforts in rebuilding their natural gas reserves, probably suggests that they can very well avoid a recession and continue to grow through the end of the year and into 2024, whereas, of course, still the general consensus is for a recession in the U.S. And so I do think, you probably got a little bit more upside going global than I think staying in the dollar. And that's one of the reasons why we're overweight emerging market local debts, one of our highest conviction ideas over the near term.
Tony, do you agree? Is that sort of where your eye is overseas, perhaps even emerging markets?
Yes, we do agree with that, Lisa. So we think that certainly the dollar strength story was a 2022 story. We've seen some stability this year. We'd expect to see some weakness as we move through the balance of this year and into next year as the Fed does go on hold while the ECB has a bit more to do. And we think the Bank of Japan will also have a bit more to do than the Fed. And so that does lead us to emerging markets as being an attractive area in the market. Central banks there were ahead of the game in terms of addressing inflationary pressures. And of course, now the headwinds from that strong dollar begin to dissipate and from a tightening Fed begin to dissipate. So we think the story in emerging markets looks pretty good to us.
Tony, just quickly here, do you think that central banks will be able to have their cake and eat it to essentially be able to hike rates even higher and still achieve a soft landing?
They will if they only hike marginally higher, one more by the Fed, maybe two by the ECB. If inflation proves to be more persistent than our base case, then they have to go further. Then they won't be able to have their cake and eat it too. And I think our base case of a soft landing or of a mild short recession will prove to be a little too optimistic, and I think we'll see a harder landing both in the U.S. and globally.
Jordan Jackson, Tony Rodriguez, both of you, thank you so much for taking the time. We are about 7 minutes here away from the open, and we can see a bit of a positive tone coming up. We'll talk through some of the morning calls as analysts reset, and then later, RBC's Lori Calvasina joining us at the opening bell with her outlook for the second half of the year. That conversation still ahead.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Time now for our morning calls to look at some of the analyst recommendations on Wall Street this morning. First up, Goldman Sachs upgrading Kellogg's to buy, saying the company offers one of the few growth stories within the food sector. Next up, Citigroup raising its Meta price target to a street-high $360, pointing to encouraging ad revenue trends. And finally, Bernstein downgrading Alphabet to market perform $125 price target, expecting tougher competition to cap near-term gains. Coming up, big tech rebounding after recording its biggest two-day decline in more than 3 months. We continue to see a build to the rally as we head closer to the open. That conversation coming up next with RBC's Lori Calvasina. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, and we do see a bit of a rebound from yesterday's losses. NASDAQ up 0.4% after losing 1.2% at the close yesterday. S&P up by a lesser 0.2%. We can see in the bond market, the yields are going a bit higher as we prepare for what we expect to hear from Fed Chair Jay Powell, possibly echoing what we heard today from Christine Lagarde tomorrow. When he speaks at the Sintra conference. We can see right now on the short end, you can see yields up. On the long end, yields lower. 10-year yields 3.71%, and crude a bit off, 0.4% decline, $69 about traded on the NYMEX. Interesting to see euro strength right now on the heels of hawkish Christine Lagarde comments. One stock to watch at the open is Walgreens. Shares under pressure after slashing its profit forecast. The CEO writing, quote, significantly lower demand for COVID-related services, a more cautious and value-driven consumer, and a recently weaker respiratory season created margin pressures in the quarter. Joining us now, Bloomberg's Abigail Doolittle, who is talking about some of the issues with respiratory issues, good issues perhaps. Abby, what's the latest?
Well, the stock right now, Lisa, is heading to its worst day since March of 2020. So that's the degree of selling pressure that we are seeing for all of those reasons that you were just talking about. So relative to the quarter that they just reported, they did beat sales by about 3%, but adjusted earnings, there was a miss there. But it's really the outlook, the adjusted earnings outlook for the year that's weighing on this stock. As you mentioned, they cut it. The range is now $4 to $4.05 from $4.45 to $4.65. So it is definitely a cut. I don't know if I would describe it as a slash, though, but investors certainly not liking it. I think it has to do with the tone that you were just talking about, the company seeing dramatically less need for COVID vaccines, COVID treatments, less respiratory issues out there. So again, good for Americans, good for consumers, good for people out there, but not so much for the company. They're also talking about the fact that consumers, because of the macroeconomic uncertainty, they're going more toward the value. I would argue, though, Lisa, this stock down about 63% from its peak back in 2018, not even the pandemic, that this kind of lumpiness for growth, both on the top and bottom line, basically low single digits for the top line and lots of uneven growth and lack of growth on the bottom line, it's not necessarily new. Investors not liking it. Again, the last I looked, the worst day since March of 2020.
Abigail Doolittle, thank you so much. Turning now to the airline industry, Delta boosting its profit outlook ahead of today's Investor Day, forecasting a record summer for overseas travel as it capitalizes on cheaper jet fuel prices and robust consumer demand. Joining us now is Chief Travel Correspondent Katie Greifeld. Katie, what's up?
It's a modest boost, but it's a boost nonetheless. Delta sees adjusted 2023 profit between $5 and $6 per share. That's at the higher end of its prior guidance, and analysts had been looking for about $5.81 a share. Now, this increase, like you say, it's largely thanks to expectations for international travel. We know that domestic demand has remained strong, and now overseas travel is starting to pick up. And like you say, Delta in particular anticipating a record summer for overseas trips. So we'll see how that plays out. But even with this morning's good news, Delta share is only up about 1.5%. They've been bouncing around a little bit. And Raymond James is pointing out that investors might have been looking for at least a 50-cent increase to its guidance. They didn't get that today. We're going to get the full picture when Delta reports in mid-July, but right now shares currently up about 1.4%.
Thank you so much, Katie. And I should note that Delta shares year-to-date up more than 33%. So perhaps also, again, that high bar. Turning now to big tech, another place of a high bar. Another day, another downgrade for Alphabet. Bernstein cutting the stock to market perform after UBS slashed its rating on Monday. The analyst warning about its rapid push into AI, writing, quote, from too slow to too fast. Google's aggressive push to integrate AI into core search results could create a near-term air pocket for advertising prices. Joining us now, Bloomberg's Ed Ludlow from San Francisco. Ed, what's the latest?
Yeah, good morning, Lisa. Bernstein, as you said, market perform from outperform. There's a lot of similarity in the commentary from Bernstein with regards to what we saw yesterday from UBS, which moved from buy to neutral. As you said, they're saying it's time to sit on the sidelines, although they do describe this stock as having been a warm hug and a favorite in the tech names for Bernstein. The problem is that as they shift towards generative AI, powered search, that will have an impact, as you flagged, near term on ad pricing, an air pocket on search ad pricing. It's interesting, we talk about this idea of consensus ratings or the ratio of buy, hold, and sell ratings. For Alphabet, it's actually pretty high, 4.655 out of a reading of 5. But for this stock, that's the lowest level since April 2018. Of course, so much of the gain that we've seen year to date has been on the enthusiasm for AI-related names. Bernstein citing that is also a risk factor for this stock. And an example, a single name example, is to the market kind of taking a time out from the AI frenzy that we've seen. In the broader context of technology, the NASDAQ 100 rebounding slightly from its biggest two-day drop since March. And of course, last week was the biggest drop for that index since March on a weekly basis as well. So things shifting, but a lot of focus when it comes to the mega caps on the outlook for the Fed and higher rates.
And Google is heading for its biggest three-day decline since February. Ed Ludlow, thank you so much. Let's continue the conversation now with RBC's Capital's Lori Calvasina, who has been constructive for quite a while. Lori, fantastic to catch up with you. As we head toward the midpoint in this year, are you changing your view on your more constructive tone?
So thanks for having me as always, Lisa. And look, I would say we haven't changed our view. I would still put us in the camp of the more constructive strategist as opposed to the bearish strategist. That being said, once the S&P kind of poked its head above 4,400, I did notice a few of our models and indicators, things started to just feel a little bit murkier over the intermediate term. So that's probably the only shift in tone we're trying to put out there right at this moment. And I think it's best captured if you look at sentiment. And this is one of the things that had really kept us, really pretty far out of that bear camp for the first half of the year, was looking at AAII net bullishness, which had started the year down around financial crisis lows. After SVB, it went right back down there again. And that's typically a very strong buy signal for the market. You get about a 15% gain over the next 12 months. Well, what we've seen over the last couple weeks is we're no longer in extremely oversold territory. We're actually starting to creep back towards overbought territory. We've been at about 15% on net bullishness in favor of the bulls. And when you get to 30%, that's typically when you see flat markets over the next 12 months. Now, we're not there yet, but I'm looking at this indicator and I can see how we can get there within the next month or two. And so we just wanted to kind of put that out there that, this does feel like it's getting to be a little bit later innings at this point.
Where would the potential pause or even declines come? Are they going to be in the tech sector? Are they going to come in some of the areas that have already gotten beaten up year to date? I'm thinking some of the small caps. I'm thinking some of the consumer discretionaries.
So what we are noticing on small caps is that that is a space, it's been trying to rally off the bottom, and I still like it very much on a longer term basis, but we are noticing that the money flows are starting to turn back in the other direction. Even though you haven't really seen the breakout there yet, money flows have been supportive, and we're starting to see that reverse a little bit. I would still stick with tech names. I do think that NASDAQ is getting a little bit overbought. If you look at the CFTC data, we're hitting new highs on NASDAQ mini positioning. That being said, I don't think you have to sort of throw all the growth stocks out at this point. A sector like communication services, where a lot of the internet names are, those earnings revisions are starting to weaken. They're actually staying stronger in tech proper. So I would tell you on the growth side of the market, be more selective there. I do think a sector like energy on the value side makes a lot of sense at this point in time, especially with rising geopolitical angst. It's been a cheap sector, slight improvement on earnings revision trends, nice dividend yields, and now we've got a little bit of geopolitical angst back into the market again. So I think that you really have to kind of spread your risk around. I think that you want to be very selective in these different buckets. I still like healthcare as a defensive bucket, especially if we do hit a little bit of a near-term air pocket in the stock market.
The distinction between being a bull and being a bear is getting more and more muddy. JP Morgan's Marko Kolanovic, who was strongly bullish last year, much more consistently bearish this year. The latest from him is, quote, "We expect a more challenging backdrop for stocks in H2 and believe risk-reward remains unattractive given the decelerating economy and a likely recession starting in 4Q23 or the first quarter of 2024, softening consumer trends, investor complacency, and the significant re-rating of stocks so far this year." Lori, what's your sense about a recession call at this point? Have we pushed it out further than the year that people currently have any visibility into?
So if you look at the consensus stats on Bloomberg, they're still looking for the most weakness in GDP on a quarter-over-quarter basis in the back half of this year. We've really still seen those statistics continue to anticipate the start of recovery in early 2024. And I do think that's probably the biggest risk to my call, is that this recession just gets pushed into next year. I am comforted by the fact, though, that I think whatever this is, whether it's a recession or a growth scare, I do think it's starting. We've started to see some deterioration in the labor market. We've started to hear companies, sort of talk about, especially on the goods side, sort of talk about some of that incremental weakness having come through. Obviously, there's also a lot of talk of resiliency, which I think reinforces the idea that this might just end up being a growth scare. But I'll tell you, Lisa, I think what's wrong in this whole kind of bearish recession needs to be priced in debate. Stocks are discounting mechanisms. This is, investing 101. And I do feel like a lot of my peers have forgotten about this. If you go back to the October lows in the equity market, the pricing was consistent with the 2023 recession. The language that people were using to get us to that low in October was all about how the Fed was pushing us into a recession with those aggressive rate hikes. And so I think we've already paid for a recession. Now we're just starting to see whether or not we get it. I think what the market is baking in right now, whether you're looking at earnings or GDP, it's baking in a 2024 recovery, a weak one albeit. But I think that idea of maybe the recovery doesn't come through, that the recession extends, that's the risk to the market. But I will tell you, Lisa, this recession discussion is just so frustrating to me because I feel like the bears have forgotten about all the work we did to price it in last year.
And Lori, this is I love that you're saying this because so many people have come on and said that bonds are looking at the now and stocks are looking at the next year, and the next year looks better than the now. And for bonds, they're looking at a potential disinflation and softness coming up in the near term. Are you saying, Lori, that we could get a recession, or we will get a recession in your base case by the fourth quarter, and that stocks can still go higher from here and even materially so?
Yes, and I think that, remember, I spent about 7 years of my career, Lisa. I've been doing equity strategy for more than 20 years, spent about 7 of it exclusively covering the small cap space. So I know that like the back of my hand. And one of the things that you always see is that riskier part of the market has an inflection midway through a recession and starts to outperform coming out. And so that corner of the market is very, very forward-looking. We have a lot of information and a lot of models that have shown us that the small caps were pricing in a recession last year. But I think what gets, a little bit tricky is I agree with a lot of your other commentators, right? When I talk to people on the fixed income side of the table, I think that they are just on a shorter term time horizon. They're digesting the daily data points. they're looking to price things in on sort of a trade of the day, and there's nothing wrong with that, but that is their time horizon. And I've just even noticed as I talk to hedge funds in particular that they're a little bit more focused on that fixed income side of the equation than equities. I think equities are being driven by longer term money right now, which is patient and which, has frankly been trying to buy any dip that it can find to really get exposure to those longer term recovery trades. Now, the volatility that I think we might get in the back half of this year, some of the changes in leadership we might get, I think are going to relate to what the shape of that recovery does look like next year. But that's an entirely different debate than what some of these bearish strategists are talking about.
Lori, just quickly, because you do focus on small caps, I'm very curious to hear your view of a recent Fed paper that said that the amount of financial distress in non-financial firms has reached a level that is higher than in most previous tightening cycles going back to the 1970s. Some people say we haven't experienced that yet. Are you worried about that? Is that sort of a tail risk for you?
So I think we have to differentiate between smaller public companies and small businesses. And one of the things we've looked at in the public company Russell 2000 space, and it's interesting, Lisa, because I got a lot of questions on this in my investor meetings last week, is what do those balance sheets look like in small cap Russell 2000 type companies? And we have seen that just like their large cap brethren, they've been able to keep interest expense relatively low against sales. And they also have really been shifting more into long-term debt. Only 10% of Russell 2000 companies have average weighted maturities on their debt between 0 and 2 years. It's about 2% in the S&P. So it's obviously worse in small than large, but it's really not that bad overall.
Lori Calvasina, you're sticking with us, which is a good thing. Coming up, President Biden addressing the Russian rebellion.
We gave Putin no excuse to blame this on the West or to blame this on NATO. We made clear that we were not involved. We had nothing to do with it. This was part of a struggle within the Russian system.
From Russia to China and what's happening on the Hill, the latest from Washington, D.C. is up next. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Bloomberg UK, your your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
We're going to keep assessing the fallout of this weekend's events and the implications for Russia and Ukraine. But it's still too early to reach a definitive conclusion about where this is going. The ultimate outcome of all this remains to be seen.
President Biden paying close attention to the developments out of Russia. This is Secretary Yellen. Plans to visit China in early July, marking the first high-level economic talks with her new Chinese counterpart, while the U.S. preps investment curbs. Here to take us through all things geopolitics, Enda Kern joining us now. And just want to first talk about the lack of reaction to what's transpired over in Russia. And honestly, even in China, we're not talking about this, but they've been taking a much more controlling role in the market as they face off with a slowing economy. What's catching your eye that we should be more focused on that we're not?
Well, on the China side, very controlled messaging, Lisa, like you say. There wasn't much commentary at all when the picture in Russia was as unclear as it was on Saturday. We have had commentary since then, making clear that in Beijing, they've said it's an internal matter for Russia. They've noted that things are calm. There was one comment from an official, though, that said there should be clear communications at all times, and maybe that's a hint that Beijing was unhappy that Moscow wasn't keeping it up to date on what exactly was going on there. But nonetheless, as you mentioned, China's trying to keep that to the sideshow. On the other hand, of course, we've got a slowdown in the economy, pressure on the markets there, but that's also about control. China clearly trying to keep a lid on the volatility there, and it speaks to the overall narrative of China's economy at the moment. The government's in charge and trying to manage this sort of steady slowdown.
And the irony as we talk about China and we think about the housing market and all the leverage there and the inflation, that they don't want to reflate necessarily through their stimulus. Here in the U.S., we're looking at a housing market that supposedly saw a big hit from interest rates rising, but's been recovering. We just got data, home prices in the U.S. rising for a third straight month. How much is this a problem for a Fed that was looking for a long and variable lag effect to really hit housing hard?
The housing story is confusing here at the moment, Lisa, no doubt about it. I mean, to make the quick observation, obviously a housing crash would be a much bigger problem for the Fed, given the wealth destruction that would have on household incomes. So in terms of raising interest rates and trying to pull off a soft landing, the Fed would probably take where it's at. But nonetheless, it is interesting that despite the 5 odd percentage points of rate hikes, house prices were expected to keep cooling. It looks as though some people are saying they may have bottomed, maybe taking off from here, adding to the whole, the unaffordability complex, adding to the whole inflation demand story side of things. It's a confusing story because, as you know, a lot of people say, why would you look to sell your house at the moment and move if you've got mortgages locked in at a rock bottom rate? But of course, rents are also under pressure. There's a lot going on in the housing market. It does look like it may have bottomed for now, but I think we'll get a clearer picture over the months ahead.
And people are saying if rates stay this high for a very long time, it might change the scenario. Enda, thank you so much, as always. Still with us is RBC's Lori Calvasina. And Lori, I'd love your view on the home builders and the dynamism that we've seen in the housing space at a time when this is supposed to be one of the harder hit areas for more restrictive monetary policy.
So look, I think the data speaks for itself, which is that we're starting to see after, a number of indicators sort of went down to typical lows, we're starting to see this recovery that's in place. And I think it just speaks to the underlying resilience of consumers and the consumer balance sheet and all the repair that was done during COVID. And by the way, just the fact that life does simply go on. And I think that the resiliency of the consumers has simply been underestimated this time around. And, we talk a lot about the World War II scenario, Lisa, sort of why we skipped a recession in 1945. And I'll give you the short answer, which is that there was a lot of strength in the underlying economy with consumers and with corporations, even though you did have technically a real recession in terms of real GDP declining and job losses. And markets back then were able to sort of focus on the big picture and sense that underlying strength. And I think this is a symptom of that underlying strength that we're seeing here today.
At a certain point, though, doesn't this mean that the Fed has to raise rates even further, Lori, and tighten that much more simply because of the lack of interest rate sensitivity?
I think that once we really start to see, and by the way, I think it's already started, but once we start to see more evidence that inflation is under control, I think the Fed is going to lose its rationale for those rate hikes. And I think at a certain point in time, they're going to get challenged on the idea of why are you pursuing this just for the sake of pursuing this? This is supposed to be something that addresses the inflation problem. And once that is under control, it looks like we're well on our way. I don't think that they're really going to have the case to keep pressing. And I think at a certain point in time, we have to all just sort of sit back and say, okay, the economy is okay, and it's okay that the economy is okay. Because of this Fed dynamic, there's been a reluctance to admit that, but it is possible the Fed is going to pull this off.
We have seen home builders rally. Are you on that camp where you see that actually continuing?
So look, you know, what I talked about with the home builders, and we don't make recommendations on that space specifically, but they did turn around last year right around when the small cap stocks started to turn around. And a lot of those do tend to be sort of small to medium in terms of their market capitalization. And so I think that, you know, very much like the Russell 2000 last summer, that part of the market sniffed out a recession pretty early. It was one of the early leaders in terms of pricing that kind of risk in.
Lori Cavacina, thank you so much. A pleasure as always. Right now, let's take a look at some of those sectors. We get to Abigail Doolittle of Bloomberg with a breakdown of what's going on today. Abby.
Well, Lisa, with the S&P 500 up about 0.3%, very light volume. We do have more sectors higher than not, led by consumer discretionary up 1%. We also have tech up 0.9%. To the downside, healthcare down 0.5%. Interesting, though, over the last 5 days, those big tech sectors, well, those are the ones that are dragging on the market. It's going to be interesting to see whether or not the market does what it did yesterday, start off a little higher like today, and then reverse lower, and whether those big tech sectors that are down over the last 5 days, whether or not they can stay up on the session.
Abigail, thank you. Coming up, the market-moving events you need to be watching. That's next in our Trading Diary.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Time now for the Trading Diary you need to be watching this week. Consumer confidence numbers coming at the top of the hour. The Fed unveiling the results of its stress tests on Wednesday. We'll hear from Chair Powell and other global central banking heads that day, plus Micron results after the closing bell, and finally, U.S. GDP and jobless claims on Thursday. This was Countdown to the Open. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience of breaking economic news. I could report it, but we got John Tucker coming up, so I'll let him report it. But some pretty decent stuff out there in terms of new home sales. Coming up, we're going to check in with Ira Jersey, Chief U.S. Interest Rate Strategist, see what's happening on his interest rate outlook. We got the Fed at the end of July with the next meeting. Dan Ives going to be in studio. Well, we can talk about anything with Dan Ives, but we're going to focus on AI and anything tech. He's just all over the place talking to investors about what's happening in the world of technology. So we're glad to get a few minutes of his time. But first, let's kick things off with Mr. John Tucker on Bloomberg.
This is an eye-opener. The latest data, new home sales poll, 763,000 in the month of May. That is a big jump from last month, way above expectations. And month over month, up 12.2%. We were expecting a decline of 1.2%. Then with the Conference Board, I'll just go right to the present situation. Way above expectations, as well as the consumer confidence at 109.7. The expectation was for 104. Last month, you'll recall, 102. So I'm going to say the consumer pretty confident out there. Earlier, we saw orders placed with U.S. factories for business equipment rising in May for a second month. Now, as far as stocks, you have the mega cap technology names leading the indexes higher right now. S&P 500 up 13 points. The NASDAQ 100 up 107 points. That's a rise of 0.75% right now. Still, recession ahead for the U.S. That's according to Tracy McMillian at Wells Fargo.
We do think that there is going to be a contraction in economic activity later this year. And we actually think that's what's needed in order to pull inflation back down into the twos.
Still, it is risk on today in the market. Walgreens Boots Alliance, that's one of the exceptions right now. That's tumbling. The company slashing its earnings forecast. Dow Jones Industrial Average, that is up right now 31 points. That's a rise of 0.1%. Again, the S&P 500 10 points higher. The Nasdaq Composite Index up 77. The Nasdaq 100 99 points higher. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Jess. Hi, Jess.
Absolutely. Jess,
Happy
good
Tuesday,
morning.
Paul.
Happy Tuesday to you. We got some economic data today. I don't know, John, that conference board expectations, 79.3, that's well above where we were last month, 71.5. So maybe people are feeling maybe a little bit better about things.
Feeling more optimistic.
The reason we focus, I mean, it's a self-fulfilling expectations. Expectation. So if they are confident, then they're going to get out there and start spending.
Yeah. Also, those May new home sales.
Yeah.
Look at that.
I don't know who these people are.
Here's my theory, having just re-entered the real estate ownership market in
The
the great
Sweeney
state of
compound or the beaches.
The Jersey Shore compound. Yeah, it's the shock of interest rates going from 3% to 6%, now 7%.
Yeah.
That kept people on the sidelines for a few months, but now people are just like, this is the new normal. I'm out there. So
wanna get out
that's
there.
my economic analysis, and I'm sticking with it.
Love
John
it.
Tucker, thanks so much. We appreciate that. Let's take a look and see what's happening in the markets here. Got a little bit of green on the screen. We'll check in with Bloomberg's markets reporter, Emily Gorfail, in a Bloomberg Interactive Broker Studio. Emily, what are you looking at today?
I'm looking at Snowflake shares of the
Okay.
company up, getting a little lift now with the rest of the risk-on rally. But they announced an AI-related partnership from NVIDIA, and I think it's interesting that we're still seeing this market frenzy related to AI. We have NVIDIA coming off of its all-time highs, and yet still companies basically just say the phrase AI, and they get a little lift in their stock price.
What are you seeing when it comes to the flows? Because obviously we've had a gangbuster first half to the year for this U.S. stock market in particular.
Yeah, I mean, we have had a really good year, but we just haven't seen those equity flows come back like they were in prior years. When you look at the ETF market, the flows have been really hesitant, specifically into the technology space. But even just at large, we're looking right now, year to date, less than $100 billion net inflows into equity ETFs. That compares with last year at this time, $208 billion into equity ETFs, and the year before that, $357 billion just for the first half of 2021. So a lot more tepid investor enthusiasm, I guess, when it comes to these equity ETFs and buying. We are seeing a lot more flows into bond ETFs, but if you look at the performance, stocks have outperformed bonds.
Walgreens Boots, I don't get this thing. I mean, the stock's down towards an 11-year low. Is this just tough comps coming off all the COVID stuff?
I think it is. It was really interesting. They cited that it was adjusted earnings forecast for and the weakening consumer. Of course, that contrasts pretty starkly with the economic data that we just got about this consumer.
The stock's the lowest in September 2010. So do I look back at this Walgreens Boots merger and say, that wasn't very good?
Yeah,
I guess that's the takeaway.
It has been weakening, and it's at a 52-week low today. It hit a new 52-week low.
Yeah, 11-year low. Boy, this is brutal.
Yeah, ticker symbol WBA down 10% this morning.
Yep. All right, how about what else is happening out there in the marketplace? I mean, because earnings start not for a couple of weeks, right?
Yeah, we're in a little bit of a holding pattern. I was speaking to one strategist from BNY Mellon who kept saying that over and over again. It's a holding pattern. We don't have the Fed until another month. We don't really have earnings picking up just yet, but we are hitting that halfway year mark. And so I think it's a good time to kind of reflect not only on the flows, but the performance that we saw in the first half of the year for the equity market, and then the performance that we could see in the second half. This is according to CFRA research. We actually, when the market performs well during the first half, we tend to see the market leaders continue to be the winners in the second half. So this is going back to 1990. Every year that the S&P 500 has posted a positive gain in the first half, the top three sectors go on to climb an average 7.7% in the second half, and they outperformed the rest of the market 57% of the time. So at least according to that history, that would suggest that our top performers, technology, consumer discretionary, would continue to outperform the market. Of course, there are a lot of people pretty skeptical that we can repeat the technology gains that we've already seen up over 30% in that sector.
Yeah, speaking of the skepticism, what are you hearing on the strategy side of things when it comes to some of these big equity strategists from the big banks?
Well, of course, we still have Morgan Stanley's Mike Wilson. Right. I know we talk about him here a lot at Bloomberg.
Can we get him in studio? I don't believe this guy even exists. I mean, I'd never even heard of this dude. But really? 6 or 9 months ago, Bloomberg's been all in on this guy. I got to meet him.
I actually did meet him when I was an intern at Bloomberg.
Amazing.
One of my roles was to greet the Bloomberg TV guests, so I did meet him. But of course, as an intern, I didn't even realize how much of a big deal he was. But his economy colleagues, they actually came out with a note today. So this is the Morgan Stanley economics team now saying that they have revamped their forecast. They now expect a July rate hike, and it's not due to any data changing, but they actually were pointing to Powell's testimony to Congress last week and how he was talking about, people on the committee believe it's appropriate to raise rates 1 or 2 more additional times. It makes sense to move rates higher. They're basically just listening to what he said and then forecasting. It sounds like this guy wants to hike a little bit more. They still expect a soft landing, but they're now projecting that we will get another, and it will be the final 25 basis point rate hike in July.
Yeah, and he's thinking more pain on the earnings front. Obviously, we're not going to get that until JP Morgan actually kicks off earnings season on July 14th. So we have a couple weeks before we get from the big banks.
All right. Emily Garfeo, thank you so much for joining us. Emily Garfeo, she's a cross-asset reporter for Bloomberg, joining us here in our Bloomberg Interactive Broker Studio. I'm just looking Mike Wilson's call here. All right, I'm looking at undergrad at Michigan, master's degree, MBA at Northwestern. Now, I'm a big fan of Northwestern's business school, so maybe I'll give this guy a shot here. But I mean, who knows? All right, let's head right to somebody I do know who's got a very strong view here, which is Ira Jersey, Chief U.S. Interest Rate Strategist, joining us from the Princeton campus of Bloomberg Intelligence.
No suspenders of the soccer.
No, he goes casual when he's in Princeton. He goes casual when he's in Princeton.
Comes in office,
I mean, there are literally cows outside wandering around the office building. I'm not kidding. Of the Princeton campus down there for Bloomberg, and that's where Bloomberg Intelligence sets up shop for a big group of the people down there. Ira, we got some economic data today that kind of, John Tucker and I were talking about it. I mean, this economy, people are buying houses. The Conference Board, people are kind of confident out there when you look at the confidence numbers. What do you make of this economy here, and how do you think it's going to, impact the Federal Reserve when we hear from them at the end of next month?
Yeah, well, I think the data that we've seen clearly, suggests that the Federal Reserve might be able to hike again, certainly one more time. Whether or not they do 2, I think is going to be very dependent on the path of the economy for the third quarter. But yeah, the data, like you said, is good. I mean, durable goods were strong, confidence was good, housing sales for May were pretty good. Now, keep in mind, some of the new home sales numbers that were that we saw are actually taking away probably a little bit from existing home sales because of things like builder incentives and the like. But nonetheless, you still see overall an economy that hasn't yet rolled over. So it's really not getting very much stronger. And when you look at some sectors, that's the case. But I think for the Fed, it does mean that if there's not likely to see a more pronounced slowdown in inflation, so therefore another interest rate hike could very well be in the cards.
Ira, the rates markets in particular have been more sensitive when it comes to when we're looking at the growth data versus obviously the inflation metrics, which is a little bit different than maybe what we would have seen last year. Is that going to continue? And what particular data points are you focused on? Because I know we're going to get another revision to GDP later this week.
Yeah, thanks very much for the question. So we did put out a note this morning noting how rates markets are more sensitive to things like the ISM manufacturing survey and retail sales instead of inflation data. Of course, the payrolls report is still the granddaddy of all data reports, and that hasn't changed and probably won't. But I think that one of the reasons why the market's more sensitive to that is because in order for the Federal Reserve to pause at this point, it doesn't necessarily need to see a bigger slowdown in inflation. what it needs to see is the economy to roll over and the economy to start to unwind some of the froth that we've seen over the past 2 years. And you just haven't seen that yet. So I think that rates markets, when we get the ISM data in a couple of days, and when we get the PCE report on Friday, those things will wind up moving the market quite significantly, especially given that we're in a reasonably liquid time period around a holiday in the United States, where you're not going to necessarily have trading desks fully staffed on Friday, Monday, or Wednesday next week. So when some of this data comes out, you can wind up seeing a lot of volatility in the market.
Right, and that jobs report actually comes out next Friday, Paul, looking at 200,000 jobs in this latest survey, unemployment coming in actually around the same level, 3.7%.
Yeah, still pretty darn low. So, Ira, we all know that it's better to look good than to feel good, as one famous person once said. So does the Federal Reserve care about the optics here? You know, the optics of, kind of holding rates steady, not raising last time, but then reaccelerating and raising rates again? To me, that's a bad look, but I'm guessing they don't care.
Well, so someone brought it up this way, which I thought was a good point. One of our a large investor, they said, like, look, the Fed was hiking at 75s, and then they slowed to 50s, and they slowed to 25s. Maybe now they're slowing to 12.5 basis points a meeting. Now, they don't hike in 12.5 basis point increments, so that would be every other meeting. And I think that that's an interesting way to look at it. But one of the from my perspective, there is this long and variable lags, and they have raised interest rates quite a lot. So the question is, will they need to hike more? So I look at things like the real federal funds rate. If inflation progresses the way that Anna Wong and the folks at Bloomberg Economics expect, we can wind up having a real Fed funds rate that's actually the highest since the early 2000s. And that would mean that policy, at least from the Fed's perspective, would be reasonably restrictive. So there is a timing issue here where maybe 25 basis points won't necessarily throw things over the edge and won't be a policy mistake. But at the same time, they've already done a lot, and they have to kind of wait and see. So it's easier for them, I think, to go in 25 basis point increments every other meeting for now, and then determine what that terminal rate's going to be later. So they're kind of kicking the can down the road a little bit by conducting monetary policy in the way that they've set out at the June meeting.
We talked about the jobs report coming next Friday. There's CPI on July 12th, and then the employment cost index actually comes out July 28th, but that's after the Fed decision. The meeting's on the 25th and the 26th. Is there enough data when it comes to the inflation front in between now and the next Fed meeting to really push them to actually hike?
Well, it's one of these things where the data itself there's only going to be 1 month of data of additional information that the Fed's going to get. So there's probably not enough in any one report that's going to push them to either hike or not hike. I think right now, the way that the Fed's line things up and what they've kind of pre-committed to is your default has to be that there's a hike in July unless the economy says otherwise. So now, is it 100%? No, it's probably 60%, right? The 65% chance of a hike. And I think the market's probably getting that right now. But interestingly, the market is still not pricing for that second hike that appeared in the dot plot. And even though the dot plot hasn't always been correct, it's interesting that the market has not believed the Fed at all. And one of the challenges then for the rate market in particular is, when do you want to get long interest rates in the front end of the yield curve? Because there's nice carry, right? You get 5% for owning a T-bill right now. But at some point, you're going to want to buy, say, 2-year notes because interest rates are going to be significantly lower going forward. And the market had been, of course, pricing for cuts later this year, which are no longer being priced into the market.
And to your point, I'm just looking at WIRP in the terminal world interest rate probability, and we see those cuts not being priced in for this year. But if you look next year, it's pretty staggering, Paul, when you see all of the amount of cuts that are already being priced in when it comes to the equity market.
I've lost my confidence in the WIRP function because it seems like it's always wrong. It looks like they're just pushing out the rate cuts from back half of this year into next year. What does the market know? Ira Jersey, that's why we go to Ira Jersey. Ira Jersey is our chief U.S. interest rate strategist for Bloomberg Intelligence based down in Princeton, and he kind of has the goods here. But you're right, you look at the warp function and, kind of holding steady, rate raising a little bit in the very near term, but then in 2024 is just, rate cut after rate cut. And it's hard to see the Fed making that big of a U-turn. Certainly, if you listen to them,
Right.
that's not what they're signaling to the market. But
Saying years.
Yes, years, exactly
Before
right.
there'd be cuts,
Yeah,
is what Powell said.
which took the market really off guard when we heard those comments. So we'll have to pay attention. That's why we have the warp function. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Paul, shares of Eli Lilly opened higher after the drug maker reported strong results from a trial of an experimental weight loss shot. Bloomberg's Charlie Pellet reports.
It is another boost for the company's efforts to dominate the burgeoning obesity drug market. According to a study released by the New England Journal of Medicine, obese patients shed an average of 24.2% of their body weight, about 58 pounds, on the highest dose of the drug after 48 weeks. The company-funded mid-stage trial also showed a quarter of those getting the highest dose lost more than 30%. Lilly is endeavoring to take the lead in the market for weight loss therapies, seen reaching $150 billion by 2031.
Thanks, Charlie. Shares of Walgreens are down more than 10% after the drugstore chain slashed its adjusted earnings forecast for the fiscal year. CEO Roz Brewer, in an earnings call, says there's been a steep drop in COVID vaccination testing, and the company is also experiencing a slower profit ramp for U.S. healthcare. And Barbie's dream house is back on the market for a dream vacation. Bloomberg's Gina Cervetti has more.
Airbnb is once again offering Barbie fans a chance to stay in a life-sized recreation of the iconic doll's dream house, this time for free toward the end of July. The oceanfront mansion in Malibu, California has been renovated in pink and is back among Airbnb's offerings to promote the upcoming Warner Brothers movie about the Mattel doll. This time the stay will center around Barbie's boyfriend, Ken.
Thanks, Gina. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets right after this.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major averages, they are all higher this morning for now. Slowdown? What slowdown? Consumer confidence rising in June to the highest level since early 2022. Latest data shows a resilient U.S. economy. New home sales, they advanced in May to the fastest pace in over a year. Orders for U.S. business equipment increased for a second month. Remember, the Fed wants to slow down to try and cool the rate of inflation, so this all suggests it may have to hike interest rates again. All that pushing treasury yields, they are higher right now. Despite the higher yields, we do have big tech leading stocks higher. You have Microsoft, Apple, Tesla, Meta Platforms, and Amazon all higher. Google parent Alphabet, that's lower. It suffered a rating cut by analysts at Bernstein. Right now, the S&P 500, 14 points higher. That's up 0.3%. The Dow is up 105 points, and the NASDAQ 100 is 54 points higher right now. That is up about 0.3%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Jess.
Thank you, JT. And Paul, we have to dig back into what we've been talking about when it comes to the NASDAQ 100.
Yep.
It's on pace for its best first half to a year ever, rivaling 1999. So we can see if that can hold on to those gains. You were there.
All right, I do.
Doing all of that. So we can see if those gains hold on to the end of the first half this Friday. But who better to bring in than Dan Ives over at Wedbush, who, as we know, is definitely someone who's a well-known tech bull. And you actually released a
Wait, you have to do a fashion update before you do anything.
We have to take a look at this.
Describe that shirt.
And Dan, you know, we are
Multicolored shirt.
streaming on YouTube, so you can't hide the shirt. It's out there. Okay.
I love it.
Actually see the shirt.
Exactly.
It's great. So you were talking to your clients about how you still see tech stocks gaining about 12 to 15% in the second half of the year, even after this gangbuster rally that we've seen in growth stocks, obviously led by AI. Tell us about your case when it comes to continued strength there in the second half potentially.
Look, we believe it's a new tech bull market that's forming. And ultimately, as someone that's covered tech going back to 90s, this I view as a 1995 internet moment. In other words, not a 1999 dot-com bubble burst. You know, I believe based on everything we've done, this is the biggest transformational tech trend that we've seen. And we were talking about $1 trillion of incremental spend that's now coming into the tech ecosystem, which is why, in my opinion, this is a green light to own tech. I think it's going to get broader and broader in terms of the rally. And many of the bears that continue to say this is hype, they're not talking to the CIOs, the CTOs, the IT spend, where, Paul, I think it's something unlike I've ever seen.
And that's kind of where I wanted to go, Dan, because you've got this perspective, long-time perspective in the tech space. In your words, when you're talking to your institutional investor clients, and I know you've been on the road a lot, how do you define AI, artificial intelligence? Because I hear it thrown about by every company that walks through that door, whether they're selling pet food or whether they're a tech company. It's everywhere, it seems like.
Well, ultimately, it's really, like when you think about the shift to cloud and what we've seen with data, processing power, it was all about you have data, whether it's coming consumer, tech, but how do you ultimately monetize? How do you ultimately mine that data? When you look at the models coming out, of course, it's Nadella, Microsoft, ChatGPT really leading it, NVIDIA in terms of the foundation. This is the start of what I'll call as an AI revolution. The use cases now that we're seeing, I'll just give you an example, developers, they potentially now could do things in an hour that took them 3 weeks. Advertising could ultimately, there's use cases, things that could take a month, now could take basically 2 hours. And who benefits? It's the software, it's the chips, it's the ecosystem. That's why I believe this is a gold rush that really is going to define, in my opinion, a new bull market for tech that's just starting.
When you were talking about how you're having these conversations with these industry players, what specifically are they telling you, and where are those pockets of strength when it comes to, say, enterprise spending?
Yeah, and I think part of it is we go back, we sat here in January, right? Hard landing, dark clouds, Armageddon, the whole. So obviously none of that's happened, but now the difference is at enterprise, from a CIO perspective, they've gone from yellow light to now potentially green light. And you're starting to see ultimately they're looking over the road and they're not seeing cars company. And it's AI that today is less than 1% of IT spend. We think next year that's potentially 8 to 10%.
Wow.
And that's ultimately, look, in my view, and it's always, and Paul, I've talked about for decades, is that the transformational tech themes, if you put them in, and you talk about, valuation downgrade today on Meta, you put them in a little PE box on some historical, doing your spreadsheet valuations from your office building, I get it.
Yep.
To me, you can't put them in that box. That's why ultimately you've missed the Apples, the Teslas, the Netflix, the Metas, and everything else. if you don't understand the transformational growth theme. And that's why right now I think it's the fourth industrial revolution that's playing out.
Now, what we've seen, and I guess it feels to me, Dan, that we are in the very top of the first inning here. And what we're saying, or what we're hearing from people like you and from others in the tech space is just buy some of the really good tech names that receive the tech spend anyway. They're going to be on the forefront. And that's a Microsoft, for example, and some others, and NVIDIA, the chip companies. When do you think there will be that Facebook moment, that Google moment, where a company born of AI, like Google was for search, Facebook was for social, when do you think we'll have that first big AI-born company, and where might it come from?
Well, I think also a lot of those AI-born companies potentially might get acquired before they're actually born. And I think that's where you're going to see massive consolidation across tech, right? A lot of these tech companies have more cash in some countries. But then I think if you look at it, I think over the next few quarters, we're going to have what I'll call that Apple 2007 iPhone moment, that Internet 1995 moment. We saw it with the guidance heard around the world from Jensen and NVIDIA, the $4 billion guidance raise. But I think that's what we're starting to see right now. So even when we come to earnings over the next month, of course, investors are going to focus on what numbers look like, guidance, next quarter or two. But there's a much bigger story playing out here, and that's why I think a lot of these tech names continue to be Rock or Gibraltar-like.
I'm glad you brought up Apple, because there's a lot of companies like that where during the internet boom, you might not have realized certain companies to that would have benefited years later. Where do you think are the winners that might be getting overlooked, and where do you think potentially are the losers right now that are just behind the game?
Sure, and I think when you look at Apple, Cook continues to play chess where others play checkers. And I think it's an install-based play, best install base in the world from a consumer perspective. iPhone 15, I believe, is going to be a mini super cycle. AI, this is just the start of what's going to be that drum roll in terms of what I view as an AI app store over the next 12 to 18 months. I think that's being overlooked as an AI play. I think Salesforce being overlooked from an AI perspective. I do think you have some pure play AI names, even like you look at names like Palantir and others that are really from a use case perspective. And I think it's really the software ecosystem. I think it's the software names right now that I really put an asterisk around, because that's going to get the predominant amount of AI spend.
What about Adobe? Because I feel like that was a player maybe people weren't focusing enough on, and then all of a sudden we had that strong report when it comes to that AI potential there.
Well, no, I think you saw it from Adobe, you saw it from MongoDB, and I think those are the barometers that we're now starting to see. Adobe, that's been just a phenomenal job that they've been able to mine into the install base, and I think that's just the tip of the iceberg of what I believe we're going to see over the next month. Look, we can maybe start to do some sort of, clock to see who could actually say AI the most in their conference calls. And that's why
Kroger mentioned it 8 times.
And to that, maybe could someone get above 100. But that's why the big question is going to be, who are the fakes versus the real ones?
So what do you think are the risks to your bull case?
So the risk, clearly macro. Things take longer. You've had multiple expansion for 6 months. Investors are patient, but then all of a sudden, if it doesn't come to fruition, and then I think the geopolitical situation, U.S., China, continues to sort of be that, lingering dark cloud. But this is going to be patience, and that's why I view it as these are moments that happen every 20, 30 years. And right now, we just happen to be living through what I view as a 1995 internet moment.
All right, we mentioned Google earlier, and to Jess's point, losers. Initially, when this kind of hit my consciousness 6 months ago, AI, I said, boy, that's going to be a real competitor, maybe the first real competitor to Google when you think about just search in general. How do you think about Google and its position vis-a-vis
Clearly,
AI?
at first, black eye in terms of coming out. They missed it. Microsoft, beat them to the game. I think for Google, the golden goose, it's actually not search. I think it's really the cloud. I mean, that is what, from an enterprise perspective, they could potentially redefine themselves on AI. And this is also, it's not a zero-sum game. It's not just one player. We're talking about what we view conservatively $800 billion, potentially in the trillions of now incremental IT spend, where 6 months ago was not here.
Just it's extraordinary, and you got to think, a winner like Google with the, engineering chops, not to mention the balance sheet will be a player there. Hey, Dan, thanks so much for joining us.
Thanks for having me.
Appreciate you coming in studio, despite the shirt. Despite the shirt. It's good stuff. Dan Ives, he's a senior analyst at Wedbush Securities, and what we love about Dan is, he's very clear in his points and his convictions.
Definitely.
But he's got the perspective to say, hey, let's put this into context of what we've seen in past cycles.
Yeah, he's been doing this a long time.
He's been doing it a long time, and it's certainly helpful to us newbies trying to get our heads around what is AI. Looking at this market here, kind of hanging in here. We're up about 1/3 of 1% on the S&P 500, getting it NASDAQ up about 0.5%. So tech, as Dan has been saying for a long time, continues to perform well, and we'll keep an eye on that. Right now, let's head down to Washington, D.C. We'll get world and national news with, I'm not really sure who.
It's Nathan
Now we'll do Nathan
Hager,
Hager.
back in my old seat.
Fantastic.
Good morning, Paul. Well, we're going to begin now with one of the key decisions that Supreme Court watchers have been waiting for at the end of its term. The High Court has rejected a sweeping Republican-backed effort to oust the long-standing role that state judges and administrators play in federal elections. In a 6-3 decision, the justices turned aside GOP arguments in a North Carolina redistricting case that the Constitution gives state lawmakers near-exclusive power to set the rules for congressional and presidential votes. This is a theory known as independent state legislature theory. Russian President Vladimir Putin is telling his troops they prevented a civil war. Putin led a Kremlin ceremony today for about 2,500 soldiers, a show of support for military leadership that the head of the mercenary Wagner group, Yevgeny Prigozhin, tried to overthrow in a failed mutiny over the weekend. Prigozhin is now in Belarus under a deal brokered by that country's president, Alexander Lukashenko. Russia's defense ministry says it has begun transferring Wagner's heavy weapons to Russian military units. Meantime, Hungary's Prime Minister Viktor Orban is dismissing the idea that Putin is weakened now. In an interview with Germany's Bild newspaper, Orban said anyone who thinks Putin might be replaced doesn't understand the Russian people or power structures. We get more from Bloomberg's Anne-Marie Horder.
What he is talking about is the power structure, that this is, in essence, a military and a security state. The FSB, the military, obviously the Kremlin. None of those agencies came behind in support of Yevgeny Prigozhin.
Bloomberg's Anne-Marie Horder in Washington. A court appearance has been postponed for a valet to Donald Trump, who's charged with helping the former president hide classified documents. Walt Nauda's lawyer told the judge he's been unable to find a Florida-based attorney and is stuck in Newark, New Jersey. Global news on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries.